So this is just like the normal profit or loss account that you know. But this one is for external use. So we don't bring sales, return inwards, then we say cost of sales, opening stock, add purchases, add carriage inwards, less purchases, returns, cost of goods available for sale. No, we don't do it like that. We do those things if the statement is going to be for internal use. The statement that you'll be preparing will be for external use. So you have to do workings for the revenue. The revenue less return inwards, we don't bring it to the work, to the face of the financial statement. You go and do it as a note, as a workings. So you bring only the net sales, you bring only cost of sales, you put all your administrative expenses together and have one total for them. So the administrative expenses like salaries, wages, electricity bill, all those things, you put them together and have only one figure for them. Your distribution expenses, bad debt, discount allow, commission, and all those things, you put all of them also together and have one figure. We don't bring those things like salary and those things. We do workings for all of them and bring some important headings. So the account that you are going to prepare in the exam will be for external use. Will be for external use. The statement of financial position, which is balance sheet. You will not be doing something that you have been doing like this. You will go to, then you have been doing something like this. You have been doing something like this. Then you have your assets. Then you say, okay, you say machinery. Then you have cost, accumulated depreciation, net book value. No, we don't do that in this one. This is done if you are preparing a financial statement for internal use. What we do is that we put all the tangible assets together as PP. So you go and do workings for them and just bring one figure. So you bring their cost, you separate their accumulated depreciation and bring only their carrying value as PP. We don't do machinery, computer, we don't write them one by one. You put all of them together as tangible assets, which is called a PP or a property, plant, and equipment. Don't go and be putting wedges in the statement of profit or loss. No, the wedges together with other items or other expenses that are administrative related, you put all of them together and name it what? Administrative expenses. That's how we do it. All the interest, the bank interest, the loan, interest on loan, and all those things, you also put all those interests together and call it what we call the finance cost. So you have to be very mindful of that. You'll be doing the right thing, but you will not be getting anything because you are bringing, instead of you doing workings for those items, you are bringing them to the face of the financial statement. All right. Okay. So the final account, I said that it can be a statement of cash flow or it can also be statement of profit or loss. So they will ask you to prepare statement of profit or loss, maybe statement of changes in equity and statement of financial position. So what we are going to do is that we are going to pick two solid questions and see how we can go about them. Okay. Okay. So we are going to be picking two solid questions. All right. Before we pick a question, what you have to know is that they have two ways of examining the final accounts. Okay. First of all, the question can give you trial balance themselves. They can give you a trial balance from scratch. They can give you a trial balance from scratch. Okay. So they'll give you a trial balance like normal trial balance. Then they will ask you to use the trial balance to prepare the statement of profit or loss and statement of financial position. Another one is that they can give you incomplete what? They can give you incomplete statements. Okay. Incomplete statement is that they can give you a draft. They can give you a draft financial statement. The draft financial statement means that the accountant has prepared a financial statement, but they haven't taken certain items into consideration. So they will give you the statement prepared by the financial accountant. Then they will now give you the issues that we are not taking into consideration, that you should now prepare a new financial statement taking into consideration the issues that we are not taking into consideration. Okay, so that is, they can ask you to prepare a draft financial statement, or they can just ask you to prepare the financial statement from scratch. But the questions that we are going to be looking at are all going to be a draft financial statement. The preparation will follow the same, whether you are preparing a new account or not, the listing will be like that. Okay, who is reading for us?
Okay, I'll read.
Okay, so
So the draft financial statements of TAFO Limited for the year ended 30th September 2008 have been prepared by the accounting officer of the company as follows. The draft statement of comprehensive income for the year ended 30th September 2008 as shown below.
okay. Okay, so
Should
what
I
you
mention
do?
the line item?
No. We answer the question as if we're in the exam hall. So first of all, read the requirements. What are they asking us to do?
So the requirement, prepare the revised statement of comprehensive income for the year ended 30th September 2008 and the revised statement of financial position as at the date using relevant IFRSs.
Okay, so let's go to the revised statement. What are the things given to us? So you can see that you have revenue, isn't it? Okay,
Yes, sir.
you have cost of sales, you have these items. The revised statement that you are going to be preparing, you will still have these items, but just that maybe the revenue is going to be changing based on a footnote that was not taken into consideration. So your revised statement will still be having the same format, like this, but just that the figures might be changing because these figures were arrived at without taking into consideration the footnote that will be given to us. So you can put the structure there like this. You can put your structure there like this. So we have the TAFO Limited revised what? Revised statement of profit or loss and other comprehensive income. If you go to the exam, you complete it for the year ended. If you go to the exam, you complete it. Okay, so we have the Ghana city here. Then we have revenue. You just put the items here. Don't do anything. Some of them you do workings for them. So don't do anything. So you just put your revenue here. So you put your revenue there. Then you have cost of sales. Then you have your gross profits. You may have other income. If you like, you can put the other income there. If there's no issue on other income, you can just put that there and move on. Okay. Because you are here to read the what? Read the footnotes. You can just assume some of the items. So you can put other income over here. If there is none, you just put dash there and move on. So you can put your admin expense here. You can put your administrative expense here, your administrative expenses. You can also put your distribution cost here, which is selling and distribution cost. Then you bring finance cost. Finance cost is the interest that you'll be having. So maybe you have finance cost. If you don't have any, you can put that there. Then you have now profit before tax. So profit before tax. Then you now go to your tax expense. Then you have your profit for the year. Okay. So maybe you might be having other comprehensive income items. So you can leave a space. Then you now come down and start with your statement of financial position. So you have the TAFO Limited statements of, so you can make it revised statement of financial position. Please don't go and be wasting your time on the footnote. Some of the items are not going to be adjusted. Some of the items, they don't need any adjustment. So you can just bring them direct. Mostly the inventory, the cash, some of the items will not be needing adjustments. So you can just read the footnote and bring them like that. Okay. So you have the statement of financial position as at, okay, you put a date there, then you come to your assets. Okay, the assets you have non-current assets. Okay, another non-current asset. Then you can put your PPE over there. Okay, property, plant, and equipment. The next non-current asset is what? Let's read the question. Okay, it's only PPE. So you can leave like 2 and move on. Okay, maybe there will be some other item over there. So you can leave some spaces there. Then you come to current assets. What are the current assets that we have? We have inventory. Okay. What again? Do you have receivables?
Trade receivables.
Okay. So we have trade receivables.
We have bank.
We have bank. You see, some of these ones, you can open the brackets and put the figures there. If there's any addition, you come and subtract or you add. Okay. Then you now count to equity and liabilities. Please, we don't do working capital here. We don't do working capital here. For the preparation, we show total asset and liability. So we have the share capital. Okay, you have the share capital. Then you have retained earnings. Okay. Then what will be the next item?
Then we have a preference share.
Okay.
A 5-year.
Okay.
11% preference share.
Okay. The preference share might be a redeemable or irredeemable. So you leave it and see whether it will be treated as part of equity or it will be treated as a debt. Okay. So there will be a footnote relating to the preference shares there. Okay. So what do we have? We don't have any non-current liabilities, isn't it?
Yes, sir.
Okay. So you can just leave us. You can just write non-current liabilities over there. There might be issue on deferred tax or something. So we write non-current liabilities there. Don't write any item under it. Okay, you leave space like 2. Then you now count to current liabilities. Okay, the current liabilities, what are the items there?
We have trade and other payables.
So we have trade and other payables. Okay, what again?
Then we have current tax.
Okay, we have the current tax. I hope that is all.
Yes, sir.
Okay, so after doing this, you can now start with your footnote one by one now. So you start with your footnote one by one. Okay, some of the items, I'm saying that some of the items, most of them will not be adjusted. Okay, the items that you are going to be adjusting mostly is the cost of sales, maybe administrative expenses, and sometimes revenue. Okay, they will give you standards. For the revenue there, it will always be the IFRS 15 that you'll be adjusting against the revenue. So they will give you standards that you'll be adjusting against each of the items. So the item that is almost adjusted or that is always adjusted is the cost of sales. You adjust the cost of sales more than any other item. So for the final account, for you to be able to be on top of this particular question, you need to know the standard more than any other thing. Yes, it's going to be, the footnote is going to be full of standards. And right. The standards that you'll be using more is the IAS 16, property, plant, and equipment, the IAS 12, income tax, IAS 36, impairment, IFRS 9, financial instruments, IAS 37, which is provisions. You can also be having issues with foreign exchange transactions. You can also be having issues with, you cannot see any special there. Okay. You can also be having issues with borrowing costs. You can also be having issues with investment property. You can also be having issues with IS2 inventories. Yes, these are some of the standards that can be examined on the final account. So you have to master them, especially the 16 and the 12. You have to master them. The financial instruments, you have to master it. So you have to, at least, even if you are not on top of some of the standards, at least these ones there, you have to really be on top of them. You have to really be on top of them. Thank you. Okay, you have to really be on top of them. Okay, so these are the standards that you have to master before you can be able to go with the final account question. So let's take the question now. Let's take the footnote one by one and try to. One thing that you have to know about the footnote is that whenever you are giving the footnote, it means that the footnotes were not accounted for. The footnotes are being discovered after the financial statement has been prepared. So all footnotes have to be treated as they are new items. They haven't been accounted for. They haven't been accounted for. Some of them will be accounted for. They will be accounted for wrongly. So you have to correct it. That is how you can be able to go with a footnote. Footnote means that they haven't been accounted for. So take it as if they have happened and do the correcting for them. That is the meaning of footnotes. Okay, let's take the A.
So footnote A.
Okay.
Included in PPE is a production machinery acquired in October 2005 at a cost of 3.25 million. The estimated useful life of this machine is 10 years. In 2006, environmental protection laws in the locality that Tafo Limited operates tightened, limiting the amount of production companies could do, especially at certain times in a day. Accordingly, an impairment review was carried out on 30 September 2006. The fair value less cost to sell and value in use were estimated at 2.34 million and 2.47 million respectively. The outcome of the impairment review was accounted for correctly in the financial statement for the year ended 30 September 2006 in accordance with IAS 36 impairment of assets. Subsequent to the impairment review, the industry of Tafo Limited has in recent time experienced a relaxation in the tight environmental laws imposed in 2006. Amount of production from production machines has increased. Consequently, an impairment review has been carried out by management of Tafo Limited on 30 September 2008 on the production of machinery again. The fair value less cost to sell and value in use estimated at the date are 1.82 million and 2.08 million respectively. PPE are recorded at their current amount at 30 September 2008, that is after depreciation for the year, but before the effect of impairment review undertaken on 30 September 2008.
Standard is this?
Please, I'm looking at A.
Yeah, which standard is this one?
IAS 36 and PPE combined.
Okay. So the thing now is, what are we going to look for now? What are we going to do? It is the last impairment review that was not recognized, isn't it?
Yes.
Okay, that is what we are going to do now, isn't it? Okay.
Mhm.
Before we can do this, we need to know the carrying value of the asset at the date of the what? The
Okay,
second
so
impairment test, isn't it? we need to know the value of what? The assets at the time that the impairment review was done for the current year. Is that not the case? Before you can carry out an impairment test, you need to know the carrying value and also the recoverable amount. Okay, so we have to determine the carrying value of the asset up to this date. What are they saying? They are saying that the company purchased an asset, but the government has passed a legislation, and the legislation is going to reduce the number of units that the asset will be producing. Okay, but after some time, that particular legislation is not that working again, it's not that effective. So the production of the asset has increased. It means that the asset will not be used up to their capacity or up to the level of their maximum capacity. So therefore, we assume that the impairment has not happened. The impairment has not happened in the first place. What is causing the impairment test is no longer there or has experienced a realization in the application. So we see that, okay, if the condition should not be there, what should have been the situation at this date? So we need to know the carrying value of the asset as at this date. Let's look at when the asset was purchased. When was the asset purchased?
October 2005.
Okay. When was the first impairment test conducted?
September 2006.
Okay. Okay. So we need to know the carrying value of the assets at September 2006 to carry out the impairment test over there. Then we can go from that place and now calculate our carrying value up to today's date. Okay, the asset was purchased in October 2005 at the cost of what? 3.25 million, isn't it? Okay.
Yes, sir.
What is the estimated useful life of the machine as at that date?
10 years.
10 years.
Okay. On September 2006, how many years have we used the asset?
1.
1 year. Okay. So let's find the carrying value of the asset. So we are starting the workings. Okay. So we are starting the workings now. So we have workings 1. Okay. We know that carrying value of the asset is calculated as what?
Cost minus accumulated depreciation.
Okay. Cost minus what? Accumulated what? Depreciation. Okay. Can we say that the carrying value is calculated as 32 over 50 minus 3250? Is it 3250? We are doing it in thousands. So we multiply by 1,000. Would that be 3250?
Yes, sir.
Yes, sir.
3250.
Okay. Divided by 10 over year. Is that correct? The depreciation is only 1 year. Is that correct?
Yes, sir.
Yeah. If that is correct, can I also calculate the carrying value as 3250 divided by 10 times 9?
Yes.
Yes, sir.
Yes.
I can also do it like that, isn't it?
Yes.
Yes, sir.
Don't go there and be complicating things for yourself that you want to do the thing the way you know it, cause then you calculate the depreciation separately. No, you are just looking for carrying value. How you can get your carrying value in a very simple way, just do it. You know that the asset will be depreciated over 10 years. You have used 1 year, it means that it will be remaining what? 9 years. So what is the depreciation every year? Multiply it by the remaining 9 years. That will give you the carrying value for the remaining 9 years. So anyhow you want to do it, that is okay. So what will be our carrying value?
2925.
Okay. 2925. Okay. Okay. At this date, we have carried out impairment test, isn't it?
Yes, sir.
Okay, so let's look at the impairment test. So we have the carrying value now. What is the recoverable amount given to us?
We have the fair value less cost to sell as 2.34, and then the value in use is 2.47.
So which one are we picking?
The highest one.
2.47.
Okay. So that will be 24.
70.
Okay. 2470. But our carrying value is what?
29.25.
So what will be the impairment loss?
$455.
Okay. 455. They say this has been accounted for correctly, isn't it?
Yes, sir.
So this is none of our business. Our business is that we want to know the carrying value of the asset as at this day. That is our business. Okay. So when was the second impairment test carried out?
That was 30th September 2008.
Okay. That is 2 years after the first one, isn't it?
Yes, sir.
Okay. Let's come here. What do we have to do? We need to know the carrying value as at that date. What will now be the value of the asset that will be depreciating for 9 years?
2470.
Okay. The asset will now be carried out, the recoverable amount, which is divided by 9 times 7. Is that the carrying value?
Yes.
Yes, that's it.
Okay. So what will be the carrying value as the reporting date?
1921.
Okay. 1921. It is 1921 that is included in what? In the statement of financial position. It is this amount that is included in the PPE there. Okay. What you are going to do is that if you are coming to do a reversal of impairment, or if you are now, the condition that is causing the impairment is no longer there, and you want to know the portion of the impairment that you are going to be reversing, what you do is that the day that they are going to be giving you the condition that the impairment is no longer there, look at the value. What's the new value of the assets now? At September 2008, what is the new value of the assets? What is the recoverable amount now?
Recoverable amount, we
2.08.
have 2.08.
Okay, that will be 2080, isn't it?
Yes, sir.
Okay, 2080. So the recoverable amount is 2080. I will tell you something right now. Okay, if the recoverable amount has increased, or the question is telling you that what is causing the impairment is no longer there, what you are going to do is that you assume that the impairment has not happened. There was no impairment in the first place. And the day that you are reversing the impairment is the day that you are carrying out the actual impairment test. So since the impairment is not there, you just ask yourself that, okay, the first impairment that I have carried out has not happened at all. That particular impairment has not happened at all. If that particular impairment has not happened at all, it is today that I'm carrying out the impairment test on the asset. So you assume that the amount that you are reversing is the first time that you are going to what? You are going to be carrying out the impairment test on the assets. It is the first time that you are going to what? Carry out the impairment test on the assets. So if the impairment has not done on 2008, what would have been our carrying value today? If the asset has not been impaired in the first place, what should have been our carrying value today?
$2,925.
Would that be, that would be, no, if the impairment has not happened, we are now in 2008. Okay, if the impairment has not happened, what would have been the carrying value? That would have been 32, 50, isn't it? 3250 divided by 10 times 7.
2275.
22.
75.
Okay. 2275, isn't it?
Yes, sir.
Okay. So our carrying value will be 2275. Okay. So the recoverable amount is what? Yeah, Jocelyn, I will take your this thing. The recoverable amount at this day is 2080. What should have been the impairment is of
195.
195.
okay. The impairment should have been 195, isn't it?
Yes.
Okay. The total impairment that should have been recognized will be 195. But what was the total impairment that we recognized on the asset?
455.
455.
Okay. What's the difference?
260.
Okay.
260.
260.
You don't reverse the 260. Okay. What you do is as at this date, as at 2020, as at 2008. Okay. If the asset has not been impaired in the first place, the carrying value should have been 2275. Okay. The recoverable amount is what? 2080. It means that the asset should now be carried. If we should carry out the impairment test on this date, the asset will be carried at what? 2080, isn't it? If we are
Yes, sir.
carrying out the impairment on 2008, the asset will be carried at 28. So this is supposed to be the carrying value of the asset. But what is the carrying value of the asset in the books?
1921.
What is the difference?
$159.
Okay. The difference is what?
$159.
159.
So it means that we need to add 159 to the asset to now bring it to what, this amount. Because if the impairment has not happened, this is supposed to be the recoverable amount of the asset as at that date. So you add the 159 to the carrying value that you have to make it 2080, and you reverse only 159 of the impairments. I will show you why it is not 260, because the impairment that we recognize is 455. If you subtract over here, that will give you 260. Okay. That particular 260 will be used for 9 years. Okay. That particular 260 will be used for 9 years. So we have used 2 years out of it already. So let's multiply by 7. Find the carrying value. Assuming this particular portion was not impaired. If it was not impaired, depreciation should have been charged on it. Do the 26 over 9 times 7. You'll be getting the 159.
So I'm getting 202.
60. 202.22.
202.
Yeah.
Yes, sir.
Okay. If this has not impaired, it should not be, suppose the residual value should have been 2. The difference between this one is 260, isn't it?
Yes, sir.
Okay. That 260 should not be impaired in the first place. So we have 260 divided by 9 times 7. Wow, it's supposed to be okay. But what you are going to do is that the asset should be carried at 2080. So you just ask yourself, what is the carrying value of the asset in the books, and how much should I add to that particular value before getting the 2080? So you debit the asset, you debit the asset, you debit the asset with the 159, then you credit your profit or loss. You are going to reverse this part of the impairments. So that's how you go about it. Okay. This particular reversal of impairment, which we are crediting, this is an income. It will be subtracted from administrative expenses. So we can now start workings for administrative expenses. So whenever there is a reversal or impairment, you just ask yourself that, okay, the impairment has not been undertaken in the first place. So this is today, it is today that I'm undertaking the impairment. So if it is today, what should have been the recoverable amount of the asset? And what is the value I have in the books? How much should I add to the value I have in the books to now bring it to what? To the recoverable amount as at today. That particular amount that you'll be adding will be the reversal of the impairment in profit or loss. So you debit the asset with that amount and reverse what? The impairment of that particular value. So what is the administrative figure there? The administrative expenses figure.
73549.
73549. Okay. So we do reversal of impairments. So the impairment that we are reversing is the amount that we are reversing is 159. It's an income. Okay. Edwin, let me make it simple for you. Okay. Which side are you confused at? If you are confused with this one, then it means that you don't know the impairment in the first place. So we cannot do magic over here. We are going to be applying the standards.
Linus.
Yes, player.
Linus.
Yes, senior.
Yeah, senior. Is the 159 the 159?
Yes.
Now my network they do something small. So can you go over the 159?
Okay. Your network is still doing. Your network is still doing the one. Yes, your network is still doing the thing small. So it means that even if I explain, you will not still get it. Okay. I will take this one again. If you are doing reversal of impairment, okay, the impairment test has been carried out first. So you have done everything, and the carrying value that you should be having from the first impairment as at today is 1921. Okay. What you do is that if you are trying to carry out an impairment test again, which is going to be resulting in the recoverable amount being higher, then what you do is, or you are going to be doing reversal of the impairment. What you do is you assume that the impairment on the asset has not happened. So it means that we haven't done the first impairment over here, which is the 2479, and we have this particular impairment. We assume that this impairment has not happened at all. This impairment has not happened at all. And the time that you are going to do the reversal is the first day that you are undertaking the impairment test on the asset. That is the first day. If that is the first day, then you use your asset at the original cost. You depreciate it to the date that you are doing the reversal. So if you are doing that, the asset will be, the carrying value of the asset using the original cost will be the 3250 divided by 3250 divided by 10 times 7, because we have used 3 years already, and that will give you 2275. As at this date, what is the recoverable amount given to you? It is 280. So it means that as at this date, the asset should be having a carrying value of 2080. But what is the carrying value of the asset in the books? The carrying value of the asset in the books is this one, because we have impaired the assets first. So this is the carrying value. So the question now is, how much should I add to this value to now bring it to the actual recoverable amount? How much should I bring to this particular? How much should I add to this particular value to make it 2080? Because this is supposed to be This is supposed to be the carrying value of the asset as at the 30th September 2008. But the one that I have, the calculation that we have done in our books based on the first impairment, this is what the company has in their books. But the carrying value should be this. So what do? How much should we add to this value to make it 2080? We just find a difference between them. So if you are adding to the asset, it means that you are debiting the asset. What will be the corresponding entry? The corresponding entry will be that we are reversing this part of the impairment. So you credit the profit or loss because impairment was charged as an expense first. Impairment was charged as an expense first. Why am I saying that you should assume that the impairment has not happened? Don't say that as at this date, you look for the what? The recoverable amount of the asset, then you subtract it from the carrying value that you have in the books. You see that if you subtract, you'll be getting 59. It's just a coincidence. It's just a coincidence. Sometimes the recoverable amount that they will be giving to you will be higher than the asset value itself. You can't find a difference between the carrying value and that particular one. The recoverable amount they will giving to you sometimes will be higher than the asset. They consider the recoverable amount as at this date is 4,000, while the asset itself is 3250. If you are bringing the asset to 4,000, it means that you are overcharging the asset because the cost of the asset itself is 3,250. So you can't bring the asset to this particular recoverable amount. So you ask yourself, if the impairment has not been undertaken on the asset, what should have been the carrying value of the asset as at this date compared with what? The recoverable amount. You will see that the asset should not have been impaired in the first place. And what should have been the carrying value? You will now reverse the portion that is supposed to reverse. Okay. Jocelyn, you wanted to say something?
I get it now.
Okay.
I wanted to ask why we didn't pick the carrying value after we depreciated, but you just explained that we should pick it at the cost. So I get it now.
If you are picking it, you can see that this is just a coincidence that 280 minus 921 is 159. Mostly they will give the recoverable amount higher than the value of the asset itself. You can't reverse. You can't bring the asset to this one 4,000 because the 4,000 is even more than the value of the asset. You can only reverse the impairment up to the value of the asset if the impairment has not been carried out on the asset. What should have been the carrying value of the asset? You only reverse the impairment up to the pre-impaired carrying value of the asset. That's what I'm giving you. That's why I'm giving you this clue. Okay, so don't be there and be saying that why we didn't take like that. No. Okay, yes, 2 hands are up.
Sir,
Yes, please.
so please, the condition that will around this is when the impairment initial, there's an impairment, there's a condition for us to do the impairment, and now the condition, if that condition does not more exist, it means that we have to reverse the first impairment that we did.
We have to
reinstate
we have to reassess the value of the assets. Okay. You have to not that you have to reverse. Sometimes you cannot reverse the full amount. You can see that we were not able to reverse the full amount. Okay. So if the condition is not there, you have to reassess the economic. You see, the reason why we do the impairment is that, okay, you purchase an asset. Okay. You purchase an asset that you are saying that the value of the asset is 20,000. And this asset is going to be producing 1,000 units every year. So you are saying that the 20,000 is going to be giving you a benefit of 1,000 units for 10 years.
I read data manual.
Okay. That is the basic idea of it. The value of the asset, the cost of the asset is 20,000, and you are saying that the asset will be helping you to produce 1,000 units every year. Okay. Right now, the asset has been involved in accidents, the asset has been involved in accidents, and something, or maybe it's a motor vehicle that it will be carrying 10,000 units every year. Okay, now the motor vehicle has been involved in accidents, and the efficiency and those things are reduced, and the assets can now carry only 800 units. Will you be saying that the value of the asset is supposed to be 20,000 again? Logically, can you say that the value of the asset is still the 20,000?
No, please.
Yes, the 20,000 is based on the what? The 1,000 units. Now the asset can only carry what? 800 units. So you ask yourself, what value of the asset will be carrying what? 800 units. What will be the worth of the asset that can carry 800 units for 10 years? That particular value that you are looking for is what we call the recoverable amount. And the reduction in the value of the asset is the impairment. So the impairment is always attributed to the economic benefit that the asset will be bringing. If you have an asset, you have a plant that you say that you'll be producing 20,000 units every year, and the value is 100,000. Okay, and you say it will be producing 20,000 units every year for 5 years. Now government has passed a legislation that is going to reduce the production of the asset to 18,000. It is only the 100,000 value of the asset that can give you what? 20,000 units. Now, government has passed a legislation that is reducing the production of the asset to 18,000. The question now is, if 100,000 is 20,000 units, what value will give us the 18,000 units? That is the recoverable amount. That is the value that we can get from the continued use of the asset. That is the value of the asset today as a result of the legislation passed by the government. And what will be the reduction? The reduction in the value of the asset will be attributing to the 2,000 units over here. And this 2,000 portion that you cannot be able to produce, that is what we call the impairment. So the value of the assets will be reduced by the 2,000 units that the asset will not be producing. That is how we call about the impairment. So the impairment is always attributed to what? To the economic benefits. If after you have operated this one, the 18,000, you have produced 18,000 for 2 years. After 2 years, the government has now withdrawn the legislation and you can still produce towards 20,000 units. You can see that after the first year, you have now based the value of the asset based on 18,000. Now you are now coming to what? 20,000. It means that you have to re-estimate the value of the asset that can give you what? The 20,000. That is the reversal that we talk about. Okay, Rob, I don't know whether I've said something. That's
Yes. Thank you.
okay. All right, let's take. So what we do is let's bring our PPE to the statement of financial position. What is the value of the PPE in the statement of financial position?
$64.24.
64.24.
424.
Then we add 159 to it, isn't it?
Yes, sir.
Okay, let's take the second footnote. That is the first note. It's just about reversal of impairment. Jocelyn, your hand is up.
Okay, sir, please. I wanted to find out if it's okay for us to put the initial amount in the bracket, like how you did it for the PPE. The
Yes,
6242.
yeah,
So in
you
case
can-
you are not able to adjust fully, you get a tick for putting that one in the bracket.
Yeah,
Is it okay?
you can put in the bracket if the additions that you are going to be doing will not be plenty. Okay. All right. So let's take the second footnote. That is about the first one. It's very simple. It's very simple. Okay.
The second footnote.
Yes, please.
On September 1, 2008, Tafo Limited purchased materials used for production of its product at $0.78. Under a 90-day credit terms, the exchange rate of $1 in cedi at the purchase date for 6 cedis. At 30 September 2008, the exchange rate of $1 in cedi is estimated at 6 cedi 15 pesos. This purchase is included in cost of sales and trade payables at their transaction value in cedi terms at 1 September 2008.
Okay. What standard is this?
IS
IS
21.
20.
Okay. So what do we do? What was done and what's supposed to be done? You see that they have recorded the transaction at the date of the transaction, isn't it?
Yes, sir.
Okay. But we purchased this on credit, isn't it?
Yes, sir.
Okay. So the time that we purchased the asset, what is the let's look at the workings relating to that. Okay. So I can put workings through here. Okay. So let's look at the date of transaction. What are you going to be doing? You are buying what? You are buying materials, isn't it?
Yes, sir.
Okay. On 1st September, how is the company going to recognize this transaction? Or what will be the entries that they will be making in respect of this transaction?
They will change the 0.78 million USD into the presentation currency. That is the Ghana cedis.
Okay. And what are they going to use that particular value for?
You debit inventories.
Okay.
No,
You
You
debit.
debit purchases and
Uh-huh.
credit payable.
Okay. You see, we don't have inventory account. All inventory are being directed to purchases account. Okay. So you debit the purchases, which is basically the inventory, but we call them purchases account. We call them purchases. So it will be translated at which rate?
Cost of
At 6 cedis.
6 cedis. Okay. Are we but sometimes you ask yourself whether the figure is, so we are going to be having debiting purchases, okay, and credit payables. Okay, sometimes the translation, you don't know whether you are dividing or you are multiplying. Okay, you can see that 1 USD is equal to what? 6 cedis, isn't it, at this date? Is that the case? Okay.
Yes, sir.
But 0.78 dollars will be equal to how many cedis? So looking at this, you see that you'll be multiplying, isn't it?
Yes.
Okay, so sometimes you can use this principle, ratio and proportion, to know whether you are dividing or you are subtracting. It's very important. Okay, so if you should pay cash for this particular item, you are buying the thing. So you ask yourself, what is the CD equivalent you are paying for this particular thing? You recognize the transactions at the CD equivalent in your books. So you debit purchases at 0.78 times 6. What are we having?
We'll have 4.68.
4 points.
68.
Okay. Okay, 4.68. Okay. But the question is, have you paid the people?
No.
Okay. So, but this transaction is what? It's at 1st September, isn't it?
Yes, sir.
The reporting date is what?
30th September.
Okay. At the reporting date, the Ghana cedi that you'll be paying the people, will it still be 4.68 million?
No.
This one, it can be yes or no, isn't it? If the exchange rate is still 6 cedi at the reporting date, then it means that it will still be 4.68. Okay. You'll be paying the person 0.78. But you will be using cedis to pay for the dollar. If you want to pay, you are going to be, if you want to pay, you are going to be paying the person 0.78 million USD. but you are in Ghana over here. So if you want to pay, you have to go and change the cedis to what? Dollars before you pay. So the question is, if you want to pay the person at the reporting date, if you want to pay them at reporting date, which is 30th September, if you want to pay them at 30th September 2008, what will be the amount that you'll be paying them? What will be the CD equivalent that you'll be paying them? Assuming you want to pay them at the reporting date, what value are you going to be paying them? 0.78 times what?
6.15.
6.15.
15.
Okay. And that will give us how much?
4.8.
Okay. That will give us 4.8. Okay. So what is happening now? The time that you bought the thing from the person, if you should have cash, you are going to pay the person 4.68. You didn't pay the person on that date. And now you are, if you want to pay the person today, you are going to be paying 4.8. What is happening there?
There'll be an increase.
Okay, there will be a loss of what? 4.8 minus what? 4.68. Okay, that will give us how much? Having 0.12.
Yes, 0.12.
Okay. The meaning is that all payables and receivables in foreign currency must be translated at the reporting date. So the time that you bought the thing from the person, the time that you bought the item from the person, this is the transaction that you are going to be doing. It's just like you buy a car from someone. So what is the amount that you bought a car at that date? You put it in the books, in your books in Ghana cedis. Now you haven't paid the person and you are going to pay the person at this date. So you ask yourself at the reporting date, if I want to pay this amount that I'm owing the person, how much am I going to use as cedis to pay? So you calculate it and compare with what? The cedis that you should have paid at the date of the transaction if you have money. So it means that instead of you paying 4.68 at the date of the transaction, you are now going to pay the person 4.8 at the reporting date if you want to pay today. The CD value has increased. It means that you are going to pay 0.12 in excess. So that is the loss over there. So what you do is that you come and do cancellation loss over there. You can adjust it against what? Cost of sales. So translation loss. Would this be added or it will be subtracted?
Added.
Okay. So this will be added. I hope we are okay with the translation loss. Okay. And this will be 120. We are doing it in 3 zeros. So that will be 120. All right. What will happen to the receivables? What do we do? What do we do to the receivables? What do we do to other payables?
We increase it by 120.
By 120 because the company only had what? The 4.68 in their books. That's what the question is saying. They are saying that this purchase is included in the cost. Please, if you are not talking or if you are done talking, you just have to.
Hello,
Yeah.
Linus.
Yes, yeah. See, I can hear you. Yeah. Your voice is not coming. So if you're using earpiece, you can remove it and talk because I can't hear you.
The figures are in millions, so I think you should leave the 3 decimal place before we now convert it to the thousands. If not, we will overstate the figures.
Okay, the figures are in million.
Yes, so like when you multiply the 0.78 by 6.15, you are getting 4.797. So we can leave it like that, and before you multiply by the thousands, shouldn't convert into 4.8 before we multiply by 1,000.
Yes, we are rounding the figures, so it's going to be like we are going to, it's not going to tally. Because
The figure you are making is 4.8, isn't it?
instead of 0.78, you can make it 7,800. 700.
Yeah.
Oh, that
When
one is
you multiply, you get 4.797.
that is
So
your
the
choice.
4.797,
The
if you are
approximation
converting,
is your choice. If you
because it
if
will
you
be
want
overstated.
no, it can never be overstated. You are using 4.8. The figure that you'll be adding to cost of sales, the same figure you'll be adding to the receiver, the payable. So it will never be under overstatement.
Yeah, but it will still balance, but it will be overstated.
4.797 is equivalent to 4.8 than 4.7.
No, you will not leave it at 4.7. No. You can leave it at 4.798. And then if you add 1,000 to it, it will be 4,797.
Okay.
If you add the 30 to it, it will be 4,797.
Okay.
You are going to add the zeros to it.
Yes.
Yeah. So for him, like when we do the exchange loss, translation loss, we will get 117 instead of 120.
Yes.
If you are following
So
what
it,
you're
it
saying.
will be 117 instead of 120.
Okay. So yes, you can. Me, I'm doing approximation. Okay, me, I'm approximating based on a million. So whatever works for you, you can go with that one because I'm getting the 117 over here. But since it's in that particular one, there's no problem with that one. It's just approximation. So that cannot be a big deal. So you can do it and get a 117. There is no problem. But maybe I'm using 120 for now. Okay. I don't want to go back to I don't want to rework what I've done. So let's just make it that particular figure. What you are saying is a laudable suggestion, but at this time you can do that one in the exam hall. Okay. Yes, in a promise.
Please, can you come again on how you get the 120 translation loss?
You said?
Please, can you come again on how you get the translation loss, please? The 120.
You mean I should come to you or I should explain the thing?
You should explain again, please.
Okay. Okay. So you are okay with the 4.68? Are you okay with the 4.68?
Yes, please. I'm okay with the 4.68.
Okay. Are you okay with the 4.8?
Yes, sir.
Okay. What's the difference? If you have money at the time that you purchase the thing, you should be paying them 4.68. Okay. But since you don't have money, you didn't pay them on that day. By the reporting date, if you want to pay them today, you still pay them 0.78, but the exchange rate will be 6.15. It means that at the end of the year, you should be paying them 4.8 instead of what? 4.68. What is the difference between them?
The 0.12.
So they are using it is in million and they are keeping 30. So I'll just multiply this one by 1,000.
Oh, okay. Okay.
All right. All right.
Thank you.
Okay, senior. Okay, so let's take our trade and other payables and we go and add a 120 to it. So 7862 plus 120. If someone wants to do workings for all of them, I don't have problem. Some people they can just say they will go and do workings and say trade and other payables and add a 120 and bring the total figure to the statement of financial position. There's no problem with that. Okay, so let's take this footnote again. What you have to do is that you are buying the item from a foreign currency. If you buy the item, you have to recognize it in your books. At the date of purchase, you ask yourself, you are using CDs. So what is the CD that I'm paying for this particular item? The meaning is that if you have cash, what is the CD that you are paying in cash for this particular item? You should be paying 4.68 million for the item. If you have cash. So you debit your assets and you credit your cash. But you don't have cash, so you are buying on credit. So you are going to be crediting payables. It means that you are owing the people. So if you should have money and pay them today, you are going to be paying 4.68. You don't have money. At the reporting, you ask yourself, if you want to pay them today, what amount are you going to be paying them in cedis? So you still be taking the 0.78, which is the amount that you are owing the people. Then you now translate it to the cedi currency using the exchange rate at the date of the reporting. So you now ask yourself, if I want to pay the people, I'm paying them 4.8 instead of me paying them 4.68 at the date of the transaction. It means that the exchange rate has now increased. So I'm going to be adding additional amount of money to pay them. So I'm making a loss of 0.12. We multiply by 120. That loss will be treated as an expense to profit or loss, and that will be added to the what? To the payables in our currency, because we have 4.68 in the books. It is now 4.8. So we have to put the CD equivalent of the 0.78 million as 4.8 million in our books. That's why we are adding the 120 back to the other payables. That is all about that one. That is IS 21. Let's take the C.
The C. The 5-year 11% preference shares presented on the statement of financial position was issued at the beginning of the current year and are recognized at par value of 13 million. The company incurred issue cost of 0.8% of the par value, and the preference share is redeemable at a premium of 5% over the par value. The effective interest of the preference share is 12%. Issue cost paid is included in administrative expenses.
Okay, what type of course is that? What type of preference shares is that?
Redeemable.
Okay, how is redeemable preference shares treated under IFRS 9? Under financial instruments, how is redeemable preference shares treated?
As a liability,
They are
financial
treated,
liability.
okay, they are treated as a debt instrument, isn't it?
Yes, please.
Okay. They are treated as a debt instrument. So it means that this particular preference share should be accounted for as a financial liability. You can see that for financial liability, the classification is only to true profit or loss and not true what? Profit or loss. True profit or loss means that the item will be there or can be sold within a year. But this particular preference shares will be there for how many years?
5 years.
So that means that it is a non-current what? Liability or non-current financial liability. Therefore, transaction cost should be capitalized, and we use the amortized cost method for the accounting. So what we do now is the issue cost should not be expense, because this is what? Not true profit or loss. So they are saying that the company incurred issue cost of what? 0.8 million on the what? On the par value. What is the par value?
30 million.
Okay, so what will be the issue cost of that?
$10,400.
1040. Hey, are you sure it's 1040?
104. Oh,
$10,400.
No, it will be 104. It's
yes.
0.8, not 8%.
0.08.
Okay,
Because there is a percentage attached to it, you know.
okay. So it will be 0.008.
Mhm.
Okay, and that the multiply by 13,000 because we are keeping 3 zeros, isn't it? Okay, that will be 10 what? 4.
104.
Okay, that 104, how should it be treated?
Well, let's say from
The actual
The fair
treatment should have
value
been
of
what?
this.
We learned it from the fair value.
The fair value, but they haven't done that. What did they do? What that should
The
have
expenses.
that should have been the actual treatment, isn't it? Okay, but right now, what have they done? Like,
You have included it in the administrative expense.
so including in administrative expenses means that they have added it to administrative expenses, isn't it?
Yes, sir.
Yes.
So what do we do? How do we
We
correct it?
will reverse by deducting.
Okay, so we come to the issue cost. What is the administrative cost given in the question?
Seven 3549.
Okay, 73549.
549.
Okay, let's now come to the accounting for the preference shares. We have the preference shares at par value, which is the value of 13,000, isn't it? Okay.
I thought we have started administrative expenses, the calculation at some.
Yes,
No,
I
are
think you
you
have started the calculations.
we've all, yes,
you have started it somewhere?
yes, where we have the reversal of impairments
Okay.
and the transaction cost.
I thought it was cost of sales. Okay. Okay. So what we do is that we go and we come and debit the preference shares and credit the what? The administrative expenses. Okay. The figure should have been subtracted from the amounts, but they have added it to the administrative expenses. So we go and reverse it and come and subtract from the liability now. So we have the preference shares and we have the par value. The par value to be 13,000, isn't it?
Yes, sir.
Then we now do what? We now take the issue cost of 104 from it, isn't it?
Yes, sir.
What are we having?
12,896.
Okay, 12,896. Then how do we account for this now? We calculate what? The finance cost on it, isn't it? Okay, so the finance cost is what? What is the effective interest rate?
12.
12%.
Okay, so 12%. So 0.12 multiplied by 12,896. Please, all redeemable preference shares are treated as a financial liability, and they are accounted for as any other debt. Debentures, how we account for debentures using the amortized cost, we account for them like that. What would be the finance cost for the year?
1548.
Okay, 1548. What will happen? They will pay a coupon, isn't it?
Yes, sir.
Okay, the coupon will be calculated using the nominal rate and then the par value. So 11% multiplied by 13,000. What are we having?
$1,430.
Okay, 1430. So what will be the closing balance of the what? Of the preference shares? What's supposed to be the closing balance? I'm having 13,014. Is that correct?
Yes, sir.
Okay. So the preference shares, what is the figure given to you in the statement of financial position?
13,000.
Okay, so the preference shares will now be under the what? The non-current liability. So we have done working for you. So you can just put maybe workings 5 over here. Then you have the 13,014. Then you go to your statement over here. You bring your finance cost. The finance cost that we have calculated was 15. 48. That will be a deduction. Okay. Let's now take the other footnote. So for that one too, we are done.
Footnote D.
Okay.
Tafo Limited has a 1-year contract with one of its institutional customers, which started in June 2008. Tafo Limited, in accordance with the contract, supplied the customer a fixed quantity of its product of 3,000 units every month at a fixed price of 200 per unit. Tafo Limited, since June 2008, has been supplying the fixed quantity of its product as per the contract. However, the price of material imported required to manufacture the company's product has increased due to shortage in materials as a result of the adverse impact of the COVID-19 pandemic and the continued depreciation of the Ghana cedis against the US dollar. The current material cost per unit is estimated at 210 per unit, and the conversion cost is also estimated as 5% per unit. Management is planning of discontinuing the supply of goods to the customer for the remaining 8 months of the contract. The contract provides a party to give the counterparty at least 2 months notice in terminating the contract. The penalty of terminating the contract is 8.5% of the sales or purchases value of the remaining unit to be supplied or bought. The only entry made in respect of the contract is revenue and product costs for the first 4 months of the contract, included in the revenue and cost of sales figures, respectively, in the draft account.
Okay. What standard is this?
IAS 37 provisions.
And which part of the 37 is this one?
Discontinued operate. Contingent liability.
Hey. Ah. Have you heard about onerous contract before?
Yes.
Okay.
Yes, sir.
What is an onerous contract?
A contract that you are going to incur more than what you get, yet you can't stop.
Okay.
I don't.
Okay.
Am I right?
Yeah, that is it. A contract that you are going to, like, the benefit of you fulfilling the contract is lower than the cost that you are going to incur to fulfill the contract, or that the benefit that you are going to be getting is lower than the additional cost that you are going to be incurring to fulfill the contract. Okay. The company has entered into agreement to supply what? A fixed quantity of each product, 3,000 units every month at a fixed price of 200 per unit. You can see that the contract is a 1 year, isn't it? The contract is what?
Yes.
It's a 1 year
For 1
contract,
year.
which started in June 2008. The reporting date is now 30th September. How many months is that?
Four months.
Okay. So it means that the question is saying that they have supplied the what? The customer for the 4 months, remaining 8 months, isn't it?
Yes, sir.
Okay. What is the contract price?
200 Ghana cedis.
Okay. So how many units are we going to supply for the 8 months now?
Twenty-four thousand.
24,000. Okay. This 24,000, we are going to determine the cost of us what? Producing the 24,000 and the benefit that we'll be getting from it. Okay. The contract price is 200. Okay. Therefore, since June has been supplying the fixed quantity of each product as per the contract. However, the price of materials imported required to manufacture the company's product has increased due to shortage in materials as a result of the adverse impact of the COVID-19 pandemic and the continued depreciation of the Ghana cedi against the US dollar. The current material cost per unit is estimated at 210. For us to buy the material for the contract or for us to buy the material for the product that we are going to be supplying, it is 210, isn't it? Okay. And the contract price is what? Is 200. You can see that we are going to spend additional cost of 10 cedi to fulfill the contract, isn't it? All right.
Yes, sir.
Let's count to this one. The conversion cost is also estimated at what? 5 cedi per unit. What is the conversion cost? The conversion cost is also estimated at 5 cedi per unit. What is the conversion cost? It doesn't mean we are not doing management accounting.
A conversion cost is a cost that is incurred in converting raw materials to finished goods.
Okay. Are we going to sell raw materials to the people or we are selling the finished goods?
Finished goods.
So before we can produce that particular product, we need to engage labor and other issues. That is the conversion cost that they are talking about. So we can't supply the product without a conversion cost. Let's now look at it. What is the additional cost that we are going to incur to fulfill this particular contract?
15 cedis.
We can see that we are incurring additional cost of 15 cedis, isn't it? Okay.
Yes, sir.
The total cost you'll be incurring is 215. Okay. But you are receiving 200 for the person. It means that you are incurring additional cost or you are making a loss of 15. That is the additional cost. Okay. This 15 will be incurred for 8 months. So let's look at the total cost that we'll be incurring or the total additional cost that we'll be incurring over the 8 months. That will give us how much? How much are we getting?
350,000.
360,000. Okay, let me put onerous contract here. Let me look at the additional cost of fulfilling the contract. So the cost will be estimated. It's a provision that we want to make. So the cost will be estimated on the total unit that you will be what? You will be producing. So you are incurring a cost of 215. You are receiving 200. So you are incurring 15. And this 15 will be multiplied by the unit that you'll be supplying over the remaining 8 months. That will give you 360,000. Okay. So if you want to fulfill the contract, this is the additional cost that you'll be incurring to fulfill the contract. Okay. The question that you are going to ask yourself is that if I want to terminate the contract today, how much am I paying? I will compare that with what the additional cost I'm going to be incurring and see which of the options that I should choose. So let's look at the penalty. The question will always give you a penalty in relating to this particular situation. So if you want to continue the contract, you are going to be incurring a cost of what? 360,000 to fulfill the contract. Let's see if we want to terminate or we want to stop what? We want to stop the contract. What will happen? If you want to stop, what is the clause in the contract?
That we are going to pay 8.5% of the sales of the purchase of the remaining units.
Okay. Right now, the purchase price is 215, isn't it?
Yes.
Okay. And selling price is what, 200, isn't it?
Yes, sir.
If you are the one, what amount are you going to pay the penalty on?
200.
You pay the penalty on 200 because the penalty will always be on the amount that you have received from the person. You can only make refund from the money that you have received from the person. So they are saying that we should pay 8.5% of that particular amount. So we find the total cost of or the total selling price of the remaining what quantity. It will be 24,000 units multiplied by 200. That will be the total proceeds that will be receiving. multiply by 0.085. How much are you receiving? How much are you paying as a penalty?
$408,000.
Okay.
480,000.
Okay. 408,000. Okay. If you want to continue the contract, you are going to incur additional cost of 360,000. If you want to terminate based on the available information that we have, which of the options are you going to choose? Will you continue or you terminate the contract?
Continue.
You continue. Okay. Therefore, you make a provision for the lower of this particular amount. So the company will make a provision for this, because if you want to continue the contract, you'll be spending a cost of what, 360,000. So make a provision, put money aside for this particular 360,000. Okay. So what will happen is that the provision has not been made. I said that footnote means that this has not been taken into consideration. So this is what we are going to do. What will be the entries that we are going to make for the provision? What will be the entries that we're making for the provision? Please, whenever you are recognizing a provision, what are the entries?
Debit P&L and credit provisions.
Okay. So the provisions will be brought to the administrative expenses. So we have 360. Okay. Then you go to other payables and other trade and other payables, because this amount will be incurred in 8 months. So it will be treated as a current liability. It will be treated as a current liability. That is about that one. Okay. Let's go to the other footnote. So look at the simple footnote that they have given you these plenty things.
Oh,
It is well.
footnote E.
Yeah.
A total dividend of 4.2
Sir.
million.
Yes, senior.
Yeah, please can you go over the note D?
Okay. Okay, this is onerous contract. What do we call onerous contract? A contract that the cost that you are going to incur to fulfill the contract is higher than what the benefit that you are going to be getting from it. You can see that you are going to be incurring a total cost of 215 and you are going to be receiving only 200. The cost that you are incurring is higher than the benefit that you are receiving. So the standard says that if it is an onerous contract, you should make provision for the lower of the present value of the additional cost that you'll be incurring or the termination cost. So the question is, the people are paying us 200 Ghana cedis. This is the contract price. This is the selling price. But before we can supply the material to them, before we can supply the product to them, we have to buy the raw material for the product at 210. And we also have to incur a conversion cost, which can be a labor cost and other costs to be able to produce the item. So in total, we are incurring a cost of 215 for an item that we are selling at 200. So the question is, what is the additional cost if we want to continue the contract? What is the additional cost that we are going to incur to fulfill the contract? The additional cost will be 15 cedis, because we are going to recoup 200 out of this from the selling price of the contract. So we are incurring additional cost of this one. So the question is, what is the total additional cost that we are going to incur to fulfill the contract? We are supplying 3,000 every month, and it's left with 8 months. So it means that we supply 3,000 8 times. So multiply by 8. That will be the unit that you'll be supplying over the 8 months. 1 unit, you will incur additional cost of 15. So you multiply it and get a 360,000. Okay. The question now is, if you want to continue the contract, you'll be making a loss or you'll be incurring additional cost of 360. The question is, this contract is not what? It's not viable. And I cannot just stand up and say I will not produce. The people will charge me a penalty or termination cost. So let me let me go with the other option. If I want to continue, this is the amount. If I want to terminate, how much am I paying now? The question says that the contract provides a party to give the counterparty at least 2 months notice in terminating the contract, because this contract is giving you a loss. So the only portion that you can do is to terminate it. They are saying that you should give 2 months notice. The penalty for terminating the contract is 8.5% of the sales purchases value of the remaining unit to be purchased or bought. You are going to be spending a cost of 215 or 210, if you want to say like that, but you are receiving only 200. You can only pay penalty on the amount that you are receiving from the person, or the amount that the person is going to be paying to you, or you charge the penalty on the lower of any of the two. Okay, so we charge a penalty on the 200. So the question is, they say the penalty should be 8.5% of the remaining unit to be supplied or bought. You are going to be supplying 24,000 units. That is for 8 months, 3,000 every month. What is the amount that you'll be receiving from it? 1 unit is 200. So you multiply by 200. This will be the selling price of the total unit that you'll be supplying over the remaining 8 months. But you are paying a finance cost, you are paying a penalty, not a finance cost, of 8.5. That will give you 0.85, and that will give you 408,000. Okay. If you want to terminate the contract, you'll be paying 408,000. If you want to continue, you will be what? You'll be incurring a cost of 360. It is clearly that you like to what? Continue. So if you are continuing, it means that you have to make a provision. You have to put money somewhere towards the 360. And that is why we say that you made a provision for the lower of any of the two. So you recognize a provision of 360 in your statement of financial position and also statement of profit or loss, because this is an additional amount that you are going to be spending. It's a cost to you, it's an expense. So it's to be treated as an expense in statement of financial position, and it will be treated as a provision because you haven't incurred this particular cost yet. So you start putting money aside towards this particular amount. That is it. I hope you are okay now.
Yes, please. Thank you.
Okay, you're welcome. Sure. Please, we don't have time. This is the place that you can get the meaning, okay? And you have to know that I'm doing standards. So if you don't understand, it means that you are not on top of the standard issues, okay? And what we do is that we basically teach all the standards, because I teach all the standards for the purpose of the final account, because I cannot gamble with your life. I don't know what they are going to bring. So the only standard that we haven't done is event. We have done all the standards in normal class. And some of those of you who follow me on YouTube, most of the standards are there. You can get your time and go through them before you go and write the exam. Let's look at the E.
The E. A total dividend of 4.2 million, including preference share dividend, was paid in the year and has been charged against retained earnings. Tax expense represents current tax for the year. The current tax for the year, after taking into consideration the above adjustment, has been estimated at 8.1 million. Ignore effect of any deferred tax.
Okay. They are saying that a total dividend of 4.2 million has been paid, including preference share dividends. Let's come here. What do you think will be the value? What is the value of the preference shares dividends? What are they calling the dividend for them? What are they calling the dividend for them? And how much is the dividend for them? Okay. You see the coupon that they are paying for what we are calling coupon is dividends. Because if it is a debt, it will be called interest. But this is preference shares, so it will be called dividend. So the 11% on the 13,000, which is the 1430, is the dividend that they are talking about. Is the dividend that they are talking about. And that particular one has been taken into consideration already. It has been paid and it has been charged as a finance cost. So if you are paying a total dividend of 4,200, and 1430 out of it is for preference shareholders. What will be the dividend for the ordinary shareholders?
$27.70.
27.
70.
Okay. So the dividend that we'll be charging to the retained earnings should be only be 2770. We'll come and look at that one later. But let's look at, so the 2770 is the dividend for the equity shareholders. Let's look at this issue and move on. All right. They are saying that the current tax for the year after taking into consideration the above adjustment has been what we estimated as 8.1 million. Ignore the effect of any deferred tax. Okay, let's go to the current tax. What is the value of the current tax? What's the value of the current tax?
9,194.
Okay, you go to the statement of profit or loss and see whether it is the same item over there.
Yes.
Okay, if it is not the same item, it means that the current tax must be adjusted by under provision or over provision. Okay, assuming that our current tax over here was 8,500. Okay, the tax expense over here is 8,500, but in the statement of financial position is 9,194. The figure in the statement of financial position is the actual current tax for the year, is the current tax estimate for the year. But if there was no other issues, it should have been 9494. It means that there was over provision over here of certain amounts. Okay, so if they are giving you a current tax estimate, you have to use the 8,100 now and use the over provision to adjust it. But since we have the same figure, it means that there was no issue of under and over provision. All right, so the current tax should now be 8,100. So this will be, so you can have the 9,194 over here and subtract a figure from it to have the 8,100. Or someone can just bring the 8,100 over here straightforward. There's no problem with that. Okay. Please, I hope we are following. So I can subtract 1094 over here. If I go to statement of profit or loss, I'll have 8,100 as my current tax. So the 9,400 will be taken away. Okay. So it means that nothing is affecting the revenue, isn't it? Let's pick the revenue figure. What figure are we having for the revenue?
245,163.
Okay, 245,163. What is the cost of sales?
Please, we didn't adjust the cost of sales.
There's no adjustment for it.
110,323.
110,323.
323.
Okay, 2, 3. So the gross profit will still be the same.
Hello, sir.
Yes, please.
First, I thought the cost of sales, we added a translation loss to it.
It is administrative expenses.
It was administrative expense.
Oh,
All the adjustments have gone to administrative expenses. Okay. Our gross profit will still be the same figure. 134. 134 what?
134,840.
Okay. We don't have any other income, so you put dash there, isn't it?
Yes, sir.
Okay, let's come to the administrative expenses. What is the total that we are going to be having?
73,766.
Okay. 73.
766.
Okay.
Yeah.
76. Yes, please.
I think we didn't include one of the item, the issue cost on the preference shares.
Yeah, the issue code 104 we subtracted.
But I've subtracted it first from somewhere.
You were trying to do it somewhere, but you didn't bring it.
Someone said I've done it somewhere already.
Yeah, so we
Okay,
didn't
so it
include.
means I have to take it over here again. Okay.
Yeah,
So issue cost will be
104.
Okay, so the total will now be what?
73766.
73766. Okay. So our administrative expenses will be 73766. Okay. Distribution is what?
24,516.
24,516. Okay. What will be our profit before tax?
$36,558.
36,558. Okay. Then we now take our figure from it.
That will be 28,458.
28,458. Okay. Let's now put our PP together.
$65,883.
Okay, 60.
583.
Okay. Inventory is what? Nothing has happened to the inventory.
Yes, sir.
Yeah. What is the figure?
873. 8736.
8736. Trade receivables is what?
Trade receivables 19807.
19807. Bank is what?
29198.
29198. Let's put them together.
57741.
57741.
741.
Total is what?
118324.
118324. What is our share capital? Nothing has happened to it.
52,000.
Okay, 52,000. We will see that we will be adjusting our retained earnings, isn't it?
Yes, sir.
Okay, we have added a wrong profit to it. Okay, so we have to adjust our retained earnings, and let's now adjust our retained earnings. I will show you how you can adjust it in 2 ways. Okay, let's look at the retained earnings over here. Okay, the retained earnings is the one as per the statement. Okay, as per the statement, how much do we have in the statement of financial position?
36109.
36109, isn't it?
Yes, sir.
Okay, how much was the profit added to it? The profit that was added is 27581. That's the
Okay,
profit for the, isn't it?
Yes, sir.
Okay, the profit that was added was 27581. Okay, but the question is, what is the actual profit for the year now?
28458.
So this is the profit that we should have added, isn't it?
Yes, sir.
Okay, then now find the difference. You should have added this profit, but you added what? The
difference is 877.
877. Okay. 3. Is someone confirming the figures?
Yes, sir.
Okay. Okay. So the difference is 7. The difference is it going to be an increase or reduction?
An increase.
Okay. An increase of how much?
877.
Okay. So we now add the increase over here, which will be 877. I'm coming in. Please, your profit is not correct. The profit is supposed to be 26910. Can you confirm again?
I'm having 26910.
Yes, please. It's supposed to be 26910. Okay, so this one also supposed to be 26. It's supposed to be something like that. The all other costs after the gross profit are being subtracted. So let's now find a difference between the gross profit now. So this is supposed not to be increased. Okay, find a difference between them and give me the figure.
671.
And that will be a reduction, isn't it?
Yes, sir.
Okay. So decrease in profits. Okay. That will be a reduction. Okay. What was the total dividend subtracted? It was 4,200, isn't it?
Sir, please, how did you get the 671?
It's the difference between the profit and the profit that was added. Okay, the retained earnings. The retained earnings that we have in the statement of financial position over here is calculated based on this profit. This profit for the year will be added to the retained earnings at the beginning, then they subtracted dividend from it before getting this particular figure. So the question now is the profit that we should have added should have been 26910, but they have added this amount. So what is the difference? It means that they have added the 671 in excess. You should be adding this, but you have added this one. It means that you have added the 671 in excess, which is the difference between these two. Are we okay now?
Okay. Yes, please. Thank you.
Okay. What was the total dividend subtracted? Let's look at that particular footnote. Okay, let's look at the last footnote. I say a total dividend of 4,200, which is 4.2 million, including preference dividend, was paid in the year and has been charged against what? Retained earnings. Which of the dividends should be charged against the retained earnings?
Ordinary dividend.
Ordinary what?
Shareholder.
Okay, ordinary dividends. So it means that they have taken what? Preference dividend from this, which should not be taken. So we come and add back. So we add the preference dividend back. So the dividend that they should take should be only 2770, but they have taken 42. So we come and add this one back. What will be the difference? I'm having what are you having? I'm having 3686.
868.
Okay. Let me show you another way. This is one way of getting it. Another way of getting it is that you can find the what opening return earnings. Okay. You know that closing return earnings is calculated as opening return earnings plus the profit for the year minus dividend will give us the closing return earnings. Do you agree?
Yes, sir.
Okay.
Yes, sir.
So we don't know the opening return earnings. Do we know?
No.
Okay, but we know that the profit added was 27 something. The profit that was added before getting the closing return earning balance we have there is 27 what?
27,581.
27,581. What was the total dividend subtracted? 4,200.
200.
Okay. Then the closing balance of the return earnings in the draft financial statement is what?
36,109.
36,109. So let's now find the opening balance. What do? We now have 36,109 plus 4,200 minus 27,581. What are you having as the opening balance?
12,728.
12,728. Okay. So knowing this one, now you can now find your actual return earnings now. Okay. So you can start with the return earnings balance drawdown, which is 12,728. Then you now add your own profit for the year, your new profit for the year, which will be 26,910. Am I correct?
Yes, sir.
Okay. Then you now take the dividends. The dividends over here now will be only the equity dividends. What are you having? You should be having 36,868.
Yeah, 36,836.
Okay, so you have so many alternatives of determining that. Any of them that works for you, that is fine. So return earnings will now be 36,868. Okay. Let's now total what will be the total value of our trade and other payables? I'm having 8342.
42.
Okay, plus 8,100. I'm having 16,442. Okay, plus 13,104 plus 52,000 plus 36,868. 118324. It's a very interesting and very simple question. But the simple over here might be relative depending on who is saying it. Okay. Let's take the question 2. Please, you are not in the exam. They will not give you any mark for the balancing. Just look for ticks. Look for ticks, not balancing. Are we okay? Because there's
Sir,
no mark.
please,
Yeah, senior.
please, can you go back to the workings?
Well, I will share the board with you, so that one there.
Okay.
But I can give you some minutes to. Which side do you want?
The workings. I joined the class quite late, a bit late.
Or this one, I will share the sheet with you, the working sheet with you. So that is not a problem.
Okay.
All right.
Thank you.
Okay. So let's take the question 2, which is also about this particular one, but it's not difficult, but let's see how we can go about it. Who is reading for us? Please, who is reading for us? Auntie Bernice, are you there?
Yes, sir.
Or today you are not in the reading this thing.
Okay. My environment is kind of noisy and silent at the same time, so I'll try.
One thing about my readers is that if you are reading in a class, you will pass. So,
Say, okay.
so if you don't want to pass, you can be hiding.
Okay, so I'm reading question 2.
Okay.
After preparing a draft statement of profit or loss for the year ended 30 September 2005 and adding the current year's draft profits before any adjustments required by notes I to V below to retain earnings, the summarized trial balance of ALCO as at 30 September 2005 is as follows.
Okay, so what are they saying? They are saying that the draft financial statement before what? Before any adjustment required by note 1 to note V below to retain earnings. Okay, so it means that they have prepared, they have set a lot of issues happening during the year, and they have used some of them to prepare the statements, and they have gotten the retained earnings now. So the retained earnings over here is the closing retained earnings balance, because this is, they consider here they have added the closing year to it. So this is including profit for the year, any dividends, then they add the opening retained earnings to it. Okay, so these are the statements over here, but let's go to the footnotes. Okay, if you see the question like this, you always have to start with the retained earnings. It's not, you see this one, they haven't give you revenue, they haven't give you anything. They have prepared the statements and they have gotten the profits. Sometimes the question can give you the profit straightforward. They will not give you revenue. They will not give you cost of sales. It means that they have done the workings. The one that we have done. This one, they have asked us to prepare the team from the beginning to the end. Okay, we choose the same figure. This one that we have done, they can also examine this question by giving you only these profits. They can give you a trial balance, and they will give you this only this profit in the trial balance. Then they will be asking you to adjust or to find the adjusted profits, taking into consideration the following adjustments. So instead of them giving the statement of financial position, they can give PPE in trial balance. They can give inventory also. They can give you like the trial balance, like the one that we have over here. Okay, so you have to be very careful with the redraft. Sometimes they can ask you to do it yourself. You prepare the statement again, but they will do the statement and give you only profit, and you adjust only the profit. You adjust only the profit. Okay. Let's come to the footnote. So seeing this question in the exam, what are you supposed to do? Auntie Bernice, what are you going to be doing?
What I say?
Yeah, if you see the question like this, what are you going to be doing?
So you come out with your asking, what am I supposed to do first?
Yes, they are asking you to prepare the schedule of
statement of
adjustment to retain earnings and
earnings.
statement of financial position, isn't it?
Yes, sir.
Okay. For the statement of financial position, what you do is you can look at the items that you have in the trial balance here. Okay, you can see the item that you have over here. You have the equity shares, you have retained earnings, you have loans, you have investment property, you have land and building, you have plants and equipment, you have current assets, you have current liabilities, you have deferred tax, you have interest. The interest paid will be treated as an expense, so it will not go there. You have the current tax, you have the suspense accounts, maybe there is a wrong transaction that has been done, you have contract to assets. So you can just put your statement of financial position there by listing some of the assets over here. So the plants and then the land, all of them will be put together to have PPE. Okay. Then you now count your current assets. The current assets, you can see that they haven't done with anything to it. They haven't done anything to the current assets. So you just put your current asset also there as a statement. You count to your equity and liabilities, you put your equity shares over there, you put your retained earnings. Then you now count to your, maybe there might be revaluation surplus, you can leave a space under the equity. Then you count your non-current liabilities. You have your loan, you are going to have your deferred tax. If you count to the current liabilities, you will be having the current liabilities as a separate item. Then you also be having a current tax as a separate item. So you can just put the statement there before you start adjusting. But since we are learning, I will start adjusting and be putting the statement also over there at once. So the schedule of statement of retained earnings, they are asking us to do the retained earnings now. So we start with the A. So the statement of retained earnings, statement of adjusted retained earnings. Okay. What you start with first is you start with the what? The retained earnings given to you. Okay. So let's go and take the retained earnings given to us. So retained, or you can say retained earnings before adjustments. Retained earnings before adjustment. What is the figure there?
It's
15,500.
15,500.
Okay, 15,500. Okay, then you now take the footnote one by one to adjust. You now take the footnote one by one to adjust. Okay, let's come. Let's take the first one.
Hi. The loan note was issued on 1 October 2004 and incurred issue costs of 1 million, which were charged to profit or loss. Interest of 1.8 million, that is 30 million at 6%, was paid on 30 September 2005. The loan is redeemable on 30 September 2009 at the substantial premium, which gives an effective interest rate of 9% per annum. No other repayments are due until 30 September 2009.
Okay. So as soon as they are giving you this particular transaction, it means that it hasn't been accounted for, isn't it? This particular transaction hasn't been accounted for in the correct manner, isn't it? Okay. Let's look at this one. The loan note was issued on 1st October 2004 and incurred issue cost of 1 million, which were charged to profit or loss. Where should the issue cost be charged to? What should be the treatment for the issue cost? What should be the treatment for the issue cost?
It has to be capitalized.
Okay, but what did they do?
They added it to they subtracted it from the profit.
So what do you go and do now?
We have to reverse it.
We have to go and add it to the profit back, isn't it?
Yes.
So we have to go and add this particular figure back because it has been subtracted from profit. We should not be subtracted. So you now come and do your issue cost over here as 1,000. Okay. So we now bring the issue cost over there as 1,000. Okay. Then what we do now is that sometimes the interest paid will not be shown in the statement of financial position. In the statement, in the trial balance rather. You can see that the interest paid on the loan is what, 1,008. The interest paid on the loan is what, 1,008. You know what interest that they're talking about? You know what they are calling the interest? Do you know what they are calling the interest?
Is it a coupon rate?
No, you calculate it before you know. So you try your coupon
6%.
6% on 30 million.
Okay. Yeah, now it's giving you 1.8.
Okay, that is a coupon, isn't it?
Yes. The 6% on the 30 is 1.8.
Okay. So that is the coupon. Okay, sometimes the coupon will not appear in the statement in the trial balance. You can see that they are putting the interest paid over here, isn't it? You can see interest paid over here. In the statement, in the trial balance, you can see interest paid of 1,800 over here. Sometimes they will not show it over here. If the interest is not showed over here, it means that they have charged the interest as a finance cost to profit or loss. But since they are showing it over here, it means that the only entry that was made that the credit cash and the debit the interest. But if the interest is not showing in the trial balance, it means that the interest has been taken to profit or loss. But since we have the interest in the trial balance over here, it means that this cannot be charged as a finance cost to profit or loss. You have to be very careful with this particular one. So we have to determine the finance cost of this particular item. You have to do the workings for this particular item. Okay, so let's do the first workings, which will be the loan notes. Okay. Okay, so let's do the loan notes. What are we going to have first? We have the par value. Okay. What is the par value? 30 million, isn't it? Is it 30 million?
Yes,
Yes,
sir,
30
30
million.
million. 30 million.
Okay. So what will happen? Issue cost, isn't it? Issue cost of 1,000. So we now be having what? 29,000. So we now calculate finance cost. Finance cost, what is the effective interest rate on this particular loan?
9%.
9%. Okay. So 0.9, 0.09 times 29,000. What are we getting?
$2,610.
Okay, 260. So what will be the coupon? Okay, 1,800. What will be the balance now?
$29,810.
29,810. Okay.
810.
Okay. You can see that the interest is what? The interest, you can see the interest paid is showing in the trial balance. It means that the interest paid has not been charged to profit or loss. If the interest paid is not showing and they say the company has paid interest and the interest paid is not showing in the trial balance, it means that the interest paid has been taken to profit or loss as an expense. But this one, since the interest paid is here, it means that they are here to treat the what? The interest. They are here to treat the interest in the statement of financial position or the statement of profit or loss. So what we do is that we now bring the total finance cost. But if the interest paid is not in the trial balance, it means that the interest has been written against profit or loss. In that case, we only find a difference between the finance cost that we are having over here. We find a difference between this 2610 and the 1,800. Then we go and subtract it from the profit because they have already subtracted 1,800. So we should go, the actual cost that should have been subtracted should have been 2,610, but they have subtracted 1,800 already. So let's go and subtract 810. But this one, the interest is still in the trial balance. It means that they haven't written the interest off against what? The profit. So you take your finance cost to this particular place as a full amount. So you now have your finance cost, which will be what case 1 of, it will be a reduction of 2,610. Okay. So if we are doing the statement of financial position, this will be the figure that will come for the, so let's start the statement of financial position. Okay. So let's start the deal limited statement of financial position. Okay, so I'll have my assets. Then I have PP over here. I'll have my current assets. I'll have my equity and liabilities. And I'll have my equity share. I'll have my retained earnings. Okay, then I'll just put a space here. If there's, maybe there can be a revaluation. So I'll have my non-current liabilities here. And I have loan. That will be 29,810. Then I have deferred tax. Then maybe I have my current liabilities over here. And I have the current tax. Okay, so we are done with the footnote 1. Let's go to the 2. Let's go to the footnote 2. I hope we are okay with the footnote 1. Please, are we okay with the footnote 1?
Yes.
Okay. So can we go to the note 2?
Note 2.
Okay.
On 1 October 2004, AL owned 2 investment properties.
Okay.
The first property had a carrying amount of 15 million cedis and was sold on 1 December 2004 for 17 million. The disposal proceeds have been credited to a suspense account in the trial balance above. On 31 December 2004, the second property became owner acquired and was transferred to land and buildings at its fair value of 6 million cedis. Its remaining useful life on 31 December 2004 was considered to be 20 years. Ignore any defectors implication of this fair value. Should I continue?
Okay, let's digest the first one first. They are saying the company owned 2 investment properties, isn't it? Okay. Go to the statement of financial position. Go to the, why do I like statement of financial position like that? Go to the trial balance. What is the investment property over here?
20,000.
20,000, isn't it? Okay. They say that on 1st October, AL owned 2 investment properties. That is the investment properties over there. The first property had a carrying amount of 15 million, was sold on 1st December 2024 for 17 million. What should have been the entry that should have been done for this disposal? If you sell an asset, what are the entries that we are going to do?
You credit
assets.
and then you debit.
Okay, so we debit cash or bank by 17 million, isn't it?
Yes.
Okay, the assets, how much are you crediting for the assets?
50 million.
The carrying value.
Okay, and what will happen to the remaining 2 million?
We'll go to
Profit or loss, isn't it? As a gain. Okay, but let's look at this one. Let's look at how this particular transaction has been recorded. That should be the correct thing that they should do. Okay, but let's look at the trial balance and see whether we still have investment properties over there. We still have investment properties, isn't it? Okay.
Yes.
So instead of them crediting the investment property with 15 million and also crediting profit or loss with 2 million, they have decided to do the what? The corresponding in suspense account, isn't it? So it means that we have to go and remove the money from suspense account and now do the correct thing. How do we do the correct thing? We now debit the suspense accounts. So workings 2, we now debit the suspense accounts with the 17 million, isn't it? Then what do we do? Credit what?
Investment property.
The investment property with 15 million. Then we credit what? Profit or loss?
Profit.
With 2 million rather, sorry. So that will be 2 million. So it means that a gain was not recognized in the, so we now count to gain on disposal. I hope we are okay with the gain. It has not been recognized for the year. So gain on disposal will be workings 2, and that will be 2,000. I hope we are okay with the gain. The gain has not been recognized. Instead of them recognizing the gain, profit or loss, they have sent the gain to suspense accounts. Okay. What will be the remaining value of the investment property?
5 million.
That will be 5 million. It is 20 million. We sold 15 million. It will be remaining what? 5 million.
5 million.
Okay. Investment property are carried at fair value, isn't it?
Yes.
All right. So they say fair value. They are using fair value method. Okay, let's come here. They say on December 2020, 2004, the second property became owner occupied and so was transferred to land and building at a fair value of 6 million. Becoming owner occupied means that they are now changing the investment property to PPE, isn't it?
Yes.
They want to now use it for administrative purposes, but they are using fair value for the investment property. So at the time that you are going to transfer the investment property, you have to transfer the investment property at a fair value to what? PP. What is the carrying value of the property that we are transferring?
5
5
million.
thousand.
Okay, but at what price are we transferring it?
6 million.
Okay, what is happening there?
Gain on
Appreciation in the value of the asset.
Okay, so there will be a
Yeah.
fair value gain on the what? On the, so fair value gain, which is on the investment property. Fair value gain on investment property is recognized in profit or loss. So you first fair value the property before you transfer. And this particular gain too has not been recognized because the investment property has not been de-recognized from the investment property. It's still there. It means that this particular transaction has not been done. If this particular transaction should have been done, then it means that the investment property should not be there. We should have added the 6 million to property, plant and equipment, and we will now add the 1 million to our profit, but they haven't done it. So we are going to remove the 5,000 from the investment property and now send 6,000 to PPE. Let's come to something over here. If an asset is PPE, what happened? If PPE,
Depreciation.
we depreciate PPEs, isn't it? Okay. When was the transfer done?
I think
It is done on December.
31st December.
Okay. What is the reporting date for this year? The reporting date is
31st.
December 2005.
okay. How many months?
Oh.
The time that we started using the asset for how many months? We use that particular asset for how many months now?
12 months, right?
Are you sure? Is it 12? It will be from
Except
1st
from
January.
December.
First December is
Um,
last day, so it will be January.
Yes,
So January to September is how many months?
that should be 9 months.
8.
So we now charge depreciation on what?
9
The
months.
depreciation on the asset transferred. So the depreciation we are going to do is, so we can now put the depreciation over here and do it one by one. Okay, depreciation will now be, let's look at the investment property transferred to PPE. Okay, to PPE. The depreciation on it will be asset that is owner occupied is PPE and it must be depreciated. Okay, investment property are not depreciated. But if you are changing it to, if you are changing the usage now, we did investment property, we know how we carry out those change in a plan or change in a use. We know how to do it. It depends on the model that you are using for the assets. If you're using fair value model, at the time that you are transferring the asset must be transferred to PPE at fair value. We look at all those things. So we are not going to be having 6,000 over 20. Am I correct? Times 9 over 12.
Times 9 over 12.
Okay. What are we having? Okay. 225. So that will be the depreciation for that one. We have other depreciable items already. So we depreciate it and put all of them together and send it to profit or loss because no depreciation has been charged for this year. So that is the first part of the footnote. We are done with it. We are no longer to have investment property in the books again. We have sold some and we have transferred some to property, plant, and equipment. So the 20,000 over there will be de-recognized because you have sold 15,000 out of it. You have transferred 5,000. There will not be any investment property for the company again. Let's take the second part.
The price of property has increased significantly in recent years, and so the directors decided to revalue the land and buildings. The directors accepted the report of an independent surveyor who on 1 October 2004 valued the land at 8 million and the buildings at 39 million on that date. This revaluation specifically excludes the transferred investment property described above. The remaining life of this building at 1 October 2004 was 15 years. AL does not make any AL does not make an annual transfer to retain profits to reflect the realization of the revaluation gain. However, the revaluation will give rise to a deferred tax liability. The income tax rate applicable to AL is 20%. Land and equipment is depreciated at 12.5% per annum using the reducing balance method. No depreciation has yet been charged on any non-current assets for the year ended 30 September 2005.
Okay. So you can see that there is an issue of revaluation here, isn't it?
Yes.
When was the revaluation done?
1st October.
Okay. So whenever revaluation is done, what do we have to do?
You have to look for either gain or
A gain or loss, isn't it?
yes.
Okay. What are the items that we are going to use to determine the gain or the loss?
The carrying value.
Carrying amount.
Okay, the carrying
And then
amount
the
at the date of the
total.
revaluation.
Mm,
The carrying amount of the asset at the date of the revaluation, and also the revalued amount as at that date. So you ask yourself, what is the value of the asset in your books? That is the carrying amount. At the date that you are revaluing the asset, what is the value of the asset in your books? And what is the value in the market now? Let's go to the statement of financial position. The 1st October is the beginning of the year, isn't it? 1st October 2004 is the beginning of the year. Are we correct?
Yes.
Okay.
Yes.
If that is the beginning of the year, then it means that our carrying value calculation will be very simple for us. You can see that land and building is how much over here? The cost.
35
million.
Okay. The depreciation relating to the building is how much?
Depreciation to building is 20,000.
So what will be the
20,000.
so what will be the carrying value?
10,000.
10,000.
Okay.
Uh,
Okay. So the carrying value of the assets as at this date will be, someone can decide to find a revaluation for them separately, but that is not necessary over here. We only find a revaluation surplus for land separately, building separately, if the company is making an annual transfer. The annual transfer will be only in respect of a depreciable item. So we do that for the building. But that one, they are not transferring any revaluation, anything. So we just we calculate the revaluation on the total. So that will be, so we are going to be having 15,000. Okay. What is the revalued amount given to us? The total revalued amount is what?
$8,000 for land.
Okay.
9 for building.
So if you put the two together, what are we having?
47,000.
Okay. So what will be
47,000.
the revaluation surplus? 47,000 minus what? 15,000. Am I correct?
32,000.
32,000. Okay. This 32,000, this revaluation is for the current year, and this has not been recognized. So you just do, okay, if you are done with this one, you bring your other comprehensive income. This revaluation will always bring an issue of what? Deferred tax. Because at this date, the carrying value of the asset will increase by 32,000 more than the tax base, because the tax authority they don't use revaluation model for the asset. They carry the asset at cost less the capital allowance. So if the carrying value of the asset and the tax base are the same on this date, you can see that the new value of the asset at this date is 47,000 against the 15,000 in the books of the tax authority. It has now increased by 32,000. The temporary difference will be 32,000, which is relating to revaluation surplus. So revaluation surplus will always bring an issue of deferred tax. We look at deferred tax on other comprehensive income items. If there's a revaluation, the revaluation will always increase the carrying value of the asset by that particular revaluation surplus. So you calculate deferred tax on it. Okay, let's see whether The question is talking about the deferred tax on that particular revaluation. As soon as you are given the tax rate, apply the deferred tax on that particular figure. Okay. From the beginning of the year, our value of the land now will be what? Will be 8,000, isn't it?
Yes.
Okay. Building will now be what?
39.
39. So we'll be depreciating building, isn't it?
Yes.
Okay. Depreciation on building will be 39,000 divided by the remaining useful life. What is the remaining useful life given to us?
15 years.
Okay. 15 years. So it means that depreciation on building will be how much?
$2,600.
2,000.
600.
Okay. Okay. Let's look at the deferred tax implication. Okay. I have to do the deferred tax. Maybe I'll forget. So let's look at the deferred tax implication on the revaluation surplus before we move on to the depreciation of the other item. So the deferred tax would be, what is the tax rate given to us?
20%.
Okay, so 20%. Okay, you can see that, however, the revaluation will give rise to a deferred tax liability, isn't it? So they have, sometimes the question can state it, sometimes they will not state it. As soon as you are giving the rates, apply the deferred tax on that one. So that will be 32,000. So what are we going to be having?
6,400.
Okay, so 6,400. Okay, it means that out of the 32,000, you will be sending 6,400 to deferred tax, and the remaining will be going to revaluation surplus in your statement of. So let's come to the revaluation surplus over here. So revaluation surplus over here, it will be the net of the tax. The meaning is that if you are paying tax on this figure, you are going to be paying a tax of 6,400. So what will be the remaining amount? That will be, you can do 0.8 times the 32,000. What are we having?
25,600.
Okay, so your deferred tax, your revaluation surplus will be 25,600. Okay, let's now go and look at other depreciation. Okay. All right. So we are done with what? The land and building. Land is not, we assume that this is a freehold land and there is no depreciation on it. Okay. What will happen right now is that plant and equipment is depreciated at 12.5% per annum using the reducing balance method. No depreciation has been charged on any non-current asset for the year ended 30th September 2005. Okay, let's now, we have to calculate depreciation on the land, the plant and equipment, isn't it? Okay, but before we can do that, it means that we need to know the carrying value because it is done on reducing balance basis. So the depreciation for this year will be charged on the carrying value. It is reducing balance, not fixed. So the depreciation for every year is charged on the net book value or the carrying value at the beginning of that year. Okay. What is the cost of the plants?
58,500.
What is the depreciation at the beginning of the year, plant and equipment?
34,500.
Yeah, depreciation 34,500.
Okay. So it means that our depreciation on the plant and equipment will be 0.125 minus 58,500 minus what? 34,500. Is that correct? Okay. So that will be the 34 minus 34,500. Okay, the bracket over here is the carrying value. So how much are you getting for the depreciation? I'm getting 3,000. Can someone confirm that? Can someone confirm the depreciation on the plant and equipment?
3,000.
Okay. What will now be our total depreciation for the year? Would it be 225 plus 2,600 plus 3,000? Would that be
58.25.
okay? Would that be the total depreciation?
Yes.
Okay. You have to know that depreciation was charged on the what? The transferred what? Property, which is 225. Okay. So we have the 5825. No depreciation has been charged. So this figure wasn't taken from what? Our retained earnings. So we now go to depreciation of PP. Then you can put the workings there, workings 3. That will give you a reduction, 5825. So after doing this, we can now put our asset schedule here. Okay. So we can put a PP schedule here. PP schedule, I will show you the simplest one. You don't have to go and be doing at cost, at depreciation, then you have the carrying value. What you do is you start with your land and building. Okay, I will show you the vertical one. You don't have to go and prepare a table and have land separately, building separately, plant and equipment separately. No, you are using time, my brother. So at the beginning of the year, our land and building figure is what? 47,000, the revalued amount, isn't it? Okay. Plants and equipment, the cost is what?
58,500.
58,500. Okay. What will be the addition? The addition will be the investment property, isn't it? Okay. That will be 6,000. Are we okay?
Yeah.
Okay. Then what will happen now is that we now look at the accumulated depreciation. The accumulated depreciation will be relating to which one? Which accumulated depreciation are we going to be bringing? It will be
Building.
no building. Building, we are now picking the revalued amount. It means that we have written the depreciation of long time.
Okay, then it will be the plant.
Yes, we take the plant. So 24,500, isn't it? The accumulated depreciation is 24,500, isn't it?
34,500.
Okay. Then we now look at charge for the year. Charge for the year will be 5825.
This is 34,50.
Okay, 3450. Okay, I hope we are okay with this. I'll also show you another way of looking at it.
Please go back again. Let me.
Okay. We are looking at the PP for this year, isn't it?
Yes, please.
Okay. At the beginning of the year, what is the value of the land and building? It's 47,000, isn't it?
Yes, please.
Which has depreciated by only 2,600. All right. Plant and equipment, you pick the cost, which is 58,500. You have transferred investment property at 6,000, which is also going to increase the PPE. Okay. You will see that the plant and equipment was like, it was bought some years ago. So we have used some part of it. So you pick the accumulated depreciation, because as at this date, someone can decide to pick 24,000 for the plant and equipment, because at the beginning of the year, plant and equipment is having only 24,000, isn't it?
Yes, please.
Okay, then you just take only the current year depreciation from it. So someone can decide to put 24,000 over here and ignore what? The 34,500. Because we are picking the values at the beginning of the year. This is the value for land and building at the beginning of the year. Plant and equipment should be 24,000. But since we are picking the cost, it means that we have to come and take the accumulated depreciation from it over here. Okay.
Okay.
The investment property is 6,000. The charge for the year, the depreciation is for the current year. So we have to reduce the building by 2,600, the plant and equipment by 3,000, and the investment property by 225. Okay. I'm saying that someone can also do this like this. Okay. Alternatively, the person can also start with land and building. Okay. With the land and building, what the person will do that is that the person will pick their cost, 35,000. Okay. Then the person will pick plants and equipment to be 58,500. And the person will bring what? Investment what? Property. Transfer of investment property at 6,000. Then the person will now bring the revaluation surplus, because the assets should be carried at their fair value. So since we are bringing the cost, it means that revaluation surplus will increase the amount. And the person will now bring the accumulated depreciation. Accumulated depreciation, they will bring 20,000 for the land and building plus the 34,500 over here. Okay. Why are we bringing the 20,000 again? Look at this. You see that 20,000 over here should be subtracted from the cost over here. If we subtract, what are we getting? 20,000 from 35. What are we getting?
15,000.
15.
Okay, you can see that we are adding the revaluation surplus. So 15 will be remaining over here. Add 32 to 15. It's not 47.
Yes.
Yeah, so you can decide to ignore the 35,000 and bring only the new value now. That is the value at the beginning of the year. The only thing that will affect it is the depreciation. Okay, so the person can decide to do it like this. There is no issue. But don't go and be putting the PP schedule. You can see that what you are going to do at the schedule is the same thing that I've done over here in a vertical format. Okay, what is the balance that you are getting at the end?
71,175.
71.
175.
Okay, so that will be the PP. Send it to your statement of financial position, straightforward. So you can say workings 5. 7115. Okay, let's now move on to another issue. So the deferred tax, we have taken care of the deferred tax. The revaluation surplus has also been taken care of. Let's now come to the III.
III. A provision of 2.4 million cedis is required on income tax on the profit for the year to 30 September 2005. The balance on current tax in the dry balance is the under or over provision of tax for the previous year. In addition to the temporary differences relating to the information in Note 2, AL has further taxable temporary differences of 10 million cedis as at 30 September 2005.
Okay, this one is relating to IS 12, isn't it?
Yes.
Okay, what is the provision for the current tax? What is the current tax provision for this year?
2.4.
Okay, as soon as you see the 2.4, this is the amount that the company is saying that they will be paying the tax authority for this year on the profit. So send it to your statement of financial position as a liability, current tax liability. So that will be 2,400 here. As soon as you get that figure, send it to your statement of financial position. That is the amount that the company is saying that they are going to be paying currently to the tax authority for this year. But what normally happens is that a company can overstate their profit for last year or underestimate, which should have been adjusted against our profits. But since it's a tax, we normally adjust it against our current year tax. Okay, so what we do is that you now look at your tax schedule. Okay, you now look for your tax schedule. So the tax schedule will always come with a current year estimate. Okay, so we start with the current year estimate. So the current year estimate is 2,400, isn't it? All right. They are saying that the tax figure over there is either under or over. Where can we find the current tax? Which side of the statement can we find it?
The credit side.
Income.
Okay, the credit side means what? We have done this before. Is it
Over.
over? Okay. If it is over, what is the effect of the over? The over is an income. Okay. Over provision is an income. Okay. So over provision is an income which will be subtracted against this one. Are we okay? Okay. You have overcharged your tax in last year, which means that you have over subtracted the tax from your profit. You have understated your profit. So it means that this over now should be added to the profit. It is like a gain. So it will reduce your current year tax estimates. Okay, so over provision will be subtracted. They are talking about something over here. They are talking about deferred tax. Okay, they are talking about deferred tax. The deferred tax over here is only relating to profit or loss items. They are saying that in addition to the temporary difference relating to the information in note II, so it means that there is a different temporary difference relating to the 32 million that we have gotten. That is relating to revaluation surplus. That is for OCI. The one given to you over here now is for profit or loss. So AL has further taxable temporary difference of what? 10 million. It means that in total, their temporary difference will be 10 plus 32 million. That will be 42 million. But out of this, 32 million is for OCI and 10 million is for profit or loss. So sometimes they can give you the total temporary difference. You have to be able to what? To separate it. Take your revaluation surplus from it. The remaining one will be for the profit or loss. So let's now calculate the deferred tax on the 10 million. They have given us a temporary difference already. They have calculated the temporary difference for us. So what will be the deferred tax on that particular figure? So deferred tax will be 20% on 10,000. What are we having? That will be 2,000, isn't it? Okay. Let's now go to our statement of financial position, the trial balance. What is the deferred tax that we have?
Mm, 2005.
2,500.
But the new provision now is what?
The new
2,000.
provision.
Okay. The new provision now is 2,000. The deferred tax balance over here, there is no portion of it that relate to what? Revaluation surplus, because this is the first time that the company is doing the revaluation. So this is purely relating to profit or loss. Okay. The provision that we have now is 2,500, but they are saying that the new provision is 2,000. What is happening?
Additional.
We have 2,500, but now they are saying that it's 2,000. What is happening there?
There's a decrease in the deferred tax.
Okay. A decrease in provision is what? Is it an expense or is an income?
It's an income.
Okay.
It's an income.
So you come here, deferred tax is adjusted. Deferred tax movement in profit or loss item, like temporary difference arising from depreciation and capital allowance, is adjusted against the current year tax. So the 2,000 over here is relating to profit or loss. So the movement will be adjusted against the what? The current year tax. So the movement will be 2,000 minus 2,500. That is a reduction, which is a gain. Then we come and take 500 from here. What are we having as the balance now? Would that be 800? Would the difference be 800?
That is correct.
Okay.
800.
So you now come as income tax expense. Income tax, we can say working is 5. Okay, that will be a reduction of 800. So let's now put our total deferred tax together. You can see that we have a deferred tax relating to revaluation surplus of what? 6,400. And we also have a new deferred tax of what? 2,000. In other words, someone can calculate the deferred tax like this, the total deferred tax like this. Okay. You can see that there was a temporary difference arising from revaluation of 32 million. That will be 32,000. And the person will now add the profit or loss item to it. Then it will now be 42,000. The person will now apply the 20% on it. Let's see what you'll be getting. I'm sure you'll be getting 8,400. Would that be 8,400?
Yes.
Okay. So that 8,400, someone can also calculate it like this. The person will now look at the fair tax workings. Okay. The person will bring the balance bill down of 2,500. And the person will now bring movement in the fair tax, which is a reduction of 500. The person will now bring revaluation surplus or OCI deferred tax, which was 0.2 times 34,000. Okay. So that would be 6,400. So our deferred tax will now be 8,400. So as soon as we are gotten this, send it
That
to
one it's 6,800.
it's 6,400. 0.2 times 32,000.
Okay.
Okay. So the deferred tax, you can say working 6, then you bring your 8,400.
Written 34,000 instead of 32,000.
I've written 34.
34 instead of 30.
Sorry. Okay, so be 32. Thank you. Okay. So as soon as you are done with that one, you can now move on. There's other issues that we have to take care of and move on. Okay. So we are done with that one now. The deferred tax, we are done with the treatment. And so this one too, as soon as we take a footnote, make sure you do it and do the entries and move on to the next one. If not, you will forget. So let's now come to the IV.
IV. Revenue includes a 3 million sale made on 1 April 2005 for maturing goods which are not biological assets. The carrying amount of these goods at the date of sale was 2 million cedis. AL Co is still in possession of the goods, but they have not been included in the inventory count and has an unexercised option to repurchase them at any time in the next 3 years. In 3 years' time, the goods are expected to be worth 5 million cedis. The repurchase price will be the original selling price plus interest at 10% per annum from the date of sale to the date of repurchase.
Okay. So they are saying that the revenue that we use in the calculation of the profits for the year includes what? A 3 million sale made on 1st April 2005 of maturing goods which are not biological assets. We did this under revenue. You see, sometimes a company will sell an asset. The company will sell an asset that they are still manufacturing. The asset is still under construction or manufacturing, mostly whiskey. It's a drink that is going to take a lot of time before they will produce it. Okay, it will take a lot of months before they will produce it. So the person is still producing the asset, but they say that they have sold the asset to you. Okay, it is not biological asset. Why are they saying that it's not biological asset? Because it is common that someone will buy a good from the owner and say that, okay, since you have the expertise in taking care of the good should be with you. Take care of it, or you want to take it and do some things. If it is time, you count for it. That practice is common. So if it is biological assets, that one it can be a revenue because it's common that someone will buy a good and keep it with you. or someone can buy a fowl and keep it with you, or cat and keep it with you. That one is normal. But apart from that particular one, if the thing is not a biological asset, any asset, mostly maturing goods or maturing asset or inventories that you sell to someone, you can only recognize revenue when the goods has been given to the third party, when the third party is now in the possession of the goods. That is the only time that you can recognize revenue. But another way is that the company can also sell the maturing goods to what? To a finance company, like a bank. For the bank, there is no revenue. We assume that the company is using the inventory as a collateral security to take loan from the bank. So the company will not recognize that particular amount as revenue. Okay, let's come here. The revenue includes 3 million sale made on 1st April of maturing goods which are not biological assets. The carrying value of these goods at the date of sale was what? 2 million. So the cost of the goods is what? The cost
2
of
million.
is 2 million, but they sold it for what? 3 million, isn't it?
Yes.
It means that they are making a profit of what?
1 million.
Okay. The company is still in possession of the goods. You are still keeping the goods. Can that be recognized as a sale?
No.
No.
Okay. But they have not included in the inventory count. It means that they have treated this particular transaction as a sale. They are written the 2 million to what? Cost of sales. And the 3 million has been taken to revenue. Since you are still in possession of the goods, you cannot recognize revenue. So you assume that the goods are still with you, but you have received the 3 million from the person as a loan. The person has given the 3 million to you. That 3 million will be treated as a loan because control, possession associated with the inventory has not been passed on to the third party. You can only recognize revenue when control, ownership, risks, maintenance associated with the inventory has been passed on to the third party. The inventories are still with you. There is no way you should write it off as what? As revenue. So what we do now is that we are going to be reversing the 3 million as revenue and also be reversing the 2 million as what? As the cost of sales. So it means that we'll be reversing the 1 million because we are making a profit of 1 million. We should subtract the 3 million and add the 2 million. In effect, we are subtracting so what we do is we are going to be debiting revenue with 3 million. Okay, then we credit loan with 3 million. Okay, we now debit inventory with 2 million. Then we credit cost of sales of 2 million. You can see that in effect, what is happening over here is that it's only 1 million that is what? Moving in the profit or loss account. So we go to the profit or loss account, then we look at the reversal of profits on manufacturing item. You can see 3,000 minus 2,000. So that particular profit will be reversed. It should not be recognized. It should not be recognized. It should be reversed. The next thing that we are going to do is that the inventory should be added to current assets. So let's go and take the value of the current assets and now adjust it. Okay, the current asset is 68,700. So we are not going to recognize a sale, and we have 68,700. Then we now add 2,000 to it. What do? We are now going to be having a loan. The loan will now be in current liabilities. So the loan will now be 3,000. Okay, this particular loan, you'll be charging interest on it. You will say that you are using the inventory to take the loan, or the money that you have received from the person is a loan because that is not a sale. You are still in possession of the goods. Okay. When was the sale done?
1st October.
1st April 2020.
April.
Okay.
Let's
So,
say 50,000.
okay, what is the reporting date?
September.
How many months is that? April to September is how
6
many
months.
months?
6 months.
6 months. Okay, it means that we charge interest 6 months on the 3,000 because that will be treated as a loan. So you charge interest because you have 10% over there. So interest on the loan will give you 0.1 times 3,000 times 6 over 12. What are we getting? 150. Would that be 150? Would that be 150?
Sir, yes, sir.
Okay. So you can now adjust your finance cost 2610 plus 150. What are we having as a total finance cost?
Seven, 2760.
2760.
60.
Okay. So that will now be a reduction. Okay. So that is about this one. The interest will be added to this one. We just do it like amortized cost. You haven't paid the interest. So this will be 3150. Okay. So that is how we go about it. And let's move on to the next one.
B. During the year, AL entered into a contract to construct an asset for a customer. The performance obligation is satisfied over time. The balance in the trial balance represents costs incurred to date, $40 million. Value of contracts billed, work certified, and cash received, $10 million. The contract commenced on 1 October 20x4 and is for a fixed price of $25 million. The costs to complete the contract at 30 September 20x5 are estimated at $6 million. AL's policy is to measure progress based on the work certified as a percentage of the contract price.
Okay. What standard is this?
IFRS 15.
You can say the first two are all what? Revenue, isn't it? Okay. The first two are all revenue. So the revenue is very important. The only question, the only thing that is going to affect revenue in the statement is always the IFRS 15. And you can see issues like maybe a sale of maturing goods and the company is still in possession of the item. The company cannot recognize revenue on that particular transaction. So they should reverse the transaction and now still keep the inventory as their own inventory. So you should reverse everything. You reverse the cost of sales. You reverse the what? The revenue too. And you treat the amount received as a loan. Another one that can affect it is that the company will make a sale today and they will be receiving the money at a future date. There's an element of finance component over there. The revenue that you are going to recognize will be the present value of the amount that you are receiving in the future. The remaining amount will be treated as an interest. Another one can also be the contract assets. It can also be the construction contract. Okay. You can see that the company entered into a contract to construct what? To construct an asset for a customer. Okay. What is the total contract price? What is the selling price for this particular contract?
25 million.
Okay. What is the total cost that the company will be incurring to complete the construction?
20 million.
20 million. Okay, that will be the cost to date because we have done some work. The cost that we incur up to date is 14 million, but the cost that we are expecting to incur before we complete the work is 6 million. So the total cost will be the 14 million, which is the cost to date plus the cost to completion. Okay. So what will be the profit? What will be the total profit on the transaction?
5 million.
Okay. 5 million. So it is very important, since we are showing only adjustments, you calculate the profit on the contracts. Okay. Profit on the contract will be calculated as the total contract price. The total contract price, which is 25 million, minus the total contract cost. Or the cost of the total contract cost, the total cost that the company will be incurring to complete the contract. Okay. And that will always be calculated as the cost incurred to date and the estimated cost to complete. And that will be 20. So the company will be having a profit of 20. The company will be having a profit of 5. Okay. The question is, have you completed all the work? As a company?
No.
No. Okay.
No.
How is the performance? So the standard says that at a point in time, the company can only recognize revenue or profit based on the percentage of completion. So the portion of the work that you have done, you access it and say, okay, what is the percentage of the work that I have done? So you recognize revenue or cost of sales or profit based on the cost or based on the portion of the work that you have done. The company AS policy is to measure progress based on the work certified as a percentage of the contract price. Okay. So what is the work certified over here?
10 million.
10 million.
Okay. What is the total contract price?
25 million.
So what will be the percentage of completion?
40%.
Okay, that will be 10 over 25 times 100, isn't it?
Yes.
Okay, we have completed only 40% of the work, so we can only recognize 40% of the work.
Revenue.
Profit. Okay.
Profit. Sorry.
This one we are doing only profit. I will show you where you show revenue and show cost of sales also separately. Okay, so our profit will be 0.4 times 5 million. How much are we having?
2 million.
Okay. So the company will recognize a profit of 2,000, but this has not been recognized. This has not been what? Recognized. Okay. Okay. So sometimes they will give you just a statement where revenue will be there. If that happens, you have to show the revenue that the company will be recognizing on this one. What will be the revenue? The revenue will be the cost of the percentage of completion times the 25, which will always be the work certified if you are using the output method. If you are using work certified, that is output method. If you are using the cost incurred to date as a percentage of the total cost, we say that is the input method. So the company will recognize a revenue of 10 million and they will recognize a cost of sales of this figure. You will find 0.4 times the total cost that you'll be incurring. So the total cost is 20 million and you have done 40%. What should have been the cost that you should have incurred on the work? And that will be 8 million. Okay, so you see that if you find the difference, it will still be what? The 2 million profit. This profit has not been recognized. So let's go and recognize the profit on the contracts. That will be 2,000. Okay, there is something that we have to look at now. Okay, in actual sense, what is the amount that we should receive from the customer? The cost of sales is what? Is 8 million. And the profit is what? 2 million, isn't it? Please, are we here?
Yes.
The cost of sales is what? The cost that we should have incurred on the contract based on completion is what? 8 million, isn't it? And we are making a profit of 2 million. So it means that if we want to bill the people, you will say that, okay, the cost that I should have incurred on, or the work that I have done, the cost that I should have incurred is 8 million. And the part of the profit is 2 million. So you are going to pay me 10 million. Okay. So the company will, the billing will be the cost of sales plus the 2 million. And that will give you 10 million. How much was received? How much was received? What is the cash receipt? What is the cash received from the question?
10 million.
Okay.
10 million.
Okay. So it means that the people have paid for the billing that we'll be doing to them, isn't it? Okay. What is the cost incurred to date?
40 million.
But what should have been the cost that we should incur?
20 million.
No. What should have been based on the completion? What should have been the cost that we should incur?
Million.
8 million.
8 million. 8
Okay.
million.
But we are incurring a cost of what? 14 million. There is a difference of 6 million, isn't it?
Yes.
This 6 million will be like we buy some raw materials in excess. So this will be an inventory or something that we call the contract asset. But I'll just tell you how the contract asset is calculated. Okay. The contract asset is calculated as this. Contract asset, which can be inventory or receivables. You're supposed to buy an item costing 8 million, but you have bought an item costing what? 14 million. It means that you have bought some items that are inventory there. So you add a 6 million to inventory, but we call it contract assets. Or some people can call it work in progress. The contract asset is calculated as cost incurred to date. Cost incurred to date. What is the cost incurred to date? 14 million, isn't it?
Yes, sir.
Okay. Then we add a profit on the contract. Profit on the contract. What is the profit that we recognize? 2 million, isn't it? Then you subtract the cash receipt. The cash received is 10,000. The difference is 6,000. You can see that it's the same as the 6 million that I'm telling you, as the company has purchased some inventory in advance, which will be inventory. So you treat that as contract assets, but that will be as current assets because the contract will last for only 2 years. And we have done some month already, so that will be added to the 6,000 will be added to our current assets. Let me look at when the contract will finish. Okay. During the year, A intends to contract to contract and assets for this. Okay. So they haven't given us a time, but they haven't given us a time, but it should be as current assets. So let's bring it as current, as contract assets, so that let's bring it as contract assets so that the difference will, so let's have contract assets here. I say someone can name it inventory. Someone can name it what? Inventory, because we're supposed to incur a cost of the item that we should buy should be 8 million, but we have bought an item which is 14 million. It means that we bought some items that are still in inventory. The company will treat it as the assets, which is what we call the contract assets, which is what we call the contract assets. So the question is telling you something. So okay. So what they have given you contract cost over here, the contract to construct asset over here. You can see that it is the 14 million minus the 10 million. That should not be accounted for. So we have done the correct thing already. So this will not be taken to the statement again. Can we now put all the items together? Let's now find the retained earnings. Can we find the retained earnings now? 15,500 plus 1,000 minus 2760 plus 3,000 minus 5,825 minus 1,800 plus 2,000. I'm getting 11,115. Can someone confirm that?
Yes, correct.
Okay. So let's go to our return
Yeah.
earnings. We have 1115. Okay. Our equity shares is how much? Is it 20,000? Equity shares in the question is how much?
Yes, 20,000.
Okay. So can we get the current liabilities now? The current assets, we have done that already. Can we get a current liabilities is 47,400? Okay, 47,400. Current liabilities is 47,400. Okay. Our current asset will now be 68 plus this will be that will be 70.
700.
Okay. Okay. So let's put them together.
One 147,875.
Okay, 147. All right. So this is all about the final account. Let's see whether we can pick some question on the standard before we close. Okay, so tomorrow we will just look at the standards, but let's start some of them for now before tomorrow. Okay. So let's see whether we can pick a question on the financial instruments. Auntie Bernice, are you there?
Yes, sir.
Okay, help us with the
Question 1.
okay.
On 1 January 2021, WL issued 12.5 million bonds of 100 cedis each for 1,250 million cedis. The related transaction cost on issuance amounted to 50 million cedis. Each bond is convertible on 31 December 2024 into 2 ordinary shares at the option of bondholders. Any unconverted bonds will be redeemed on that date at par value. Under the terms of the bond, there is no interest on bond for 2021 and 2022. However, interest is payable at 16% per annum on 31 December 2023 and 2024. On the date of issue, market interest rate for similar debt without conversion option was 12% per annum payable each year. However, on account of transaction costs incurred on issuance of bonds, the effective interest rate could increase to 13.2% per annum. If the financial statement, in the financial statement, the proceeds have been recorded as convertible bond classified under equity and the transaction cost has been expensed out.
Okay. All right. So which this is under financial instrument, isn't it?
Yes, sir.
But it is what? Which type of instrument is that?
It's a hybrid.
Convertible.
Okay. So what we do is that we find the debt component and also what?
The equity component.
The equity component. So the debt component is the one that you have to find first. Is the easiest one. The debt component is just the present value of all the cash flows that the holders will be receiving from the company. Okay. You see that the company has issued 12 point what? 12.5 million at 100 cities. So the total value will be 1,250 million. Okay, the related transaction costs on each one amounted to what? 50 million. Each bond is convertible on 31 December 2024 into 2 ordinary shares at the option of the bond. As soon as they say the instrument is, sometimes they will not say it is convertible, but they will say it can be converted into equity shares. As soon as they say it can be converted, it means that it will be a hybrid instrument. So what you do is that you should be able to separate it. You should be able to separate it. You see the transaction cost. The treatment is that it should be taken from, it should be capitalized. We don't capitalize the transaction cost. We don't capitalize the transaction cost at the initial stage by subtracting it from the fair value. No, we don't do it like that. You are having equity and liability. So we want to know what portion of the transaction cost is on the equity and what portion of the transaction cost is on the debt instrument. So what we do is that we find their value first before we use their value to what? To apportion the transaction cost. So what we do is we do the separation. So let's do the separation. Separation, we always do the debt component. So you use your present value method over here. We have the years, we have the cash flow, we have the discount factor, and we have the present value. The discount factor, we assume that the instruments are being issued under normal market condition. So we use the interest rate of a similar bond without conversion. That will be the discount factor. So let's come to the question here. Let's come to the question here. So if you come here, what is the interest? What is the interest rate for a similar bond without conversion?
4%.
Okay, that will be the interest. Okay, that will be the discount factor, 12%. Okay, the bond is for how many years? The bond is issued on 1st January 2021, and it will be redeemable, or it will be convertible, or redeemable on 31 December 2024. How many years is that? 2021, 2022, 2023, 2024.
4 years.
4 years. Okay. So sometimes we use annuity, but let's do it 1, 2, 3, 4. Sometimes you can use annuity to present value the coupon. Okay, the cash flow, the money that the company will be receiving under this particular or for this particular instrument is the coupon. Under the terms of the bond, there is no interest on bond for 2021 and 2022. Do you know the interest that they are talking about? Is the coupon. Is the interest. What is the coupon rate? The coupon rate is 16%. Okay. It doesn't mean that the company is not going to pay them interest. There is no interest for that year. The interest for that year will be sent to the following year. Then they will pay together with what? The last 2 years interest. It doesn't mean that it's a zero interest for those years, but it will be accumulated and paid together with the remaining interest. So those interests that are not to be paid are being factored into this particular value. That is why the interest rate is higher, because under normal circumstance, the coupon rate will always be lower than the effective interest rate. But why is it higher? Because of the interest that the company didn't pay for those years. But what we do is that we are not going to have any cash flow for this year. So this will be 0, this will be 0, this will be 0, this will be 0, this will be 0. However, what will be the interest for the last 2 years? 16% on the nominal value. What are we getting? I'm getting 200.
200. Yeah.
Okay. So that will be 200. The last year will be what? The last year, what will be the total amount that they will be receiving? They will be receiving the interest together with what?
Interest.
Together with?
The 1250.
Okay. They will be receiving the interest together with the coupon. So what that will give us how much?
1450.
That is
Okay.
1450.
Let's now look at the discount factor for each of them. What is the discount factor for the third year? 12%.
Zero 0.712.
Okay. The fourth year is what?
Zero 0.636.
0.636. Someone should be confirming the discount factor. So what will be the present value now? I'm having 142.4 here.
You are correct.
Okay.
Year 4 is 921.50.
Okay. Hey, I'm getting 922.2.
Okay, I did the multiplication with, I didn't approximate. So let me do it.
Always approximating the exam. What will be the total value?
Okay. That will be 1064.6.
Okay, what will be the difference?
$185.4.
185.4. So equity component is this. Please, sometimes, yeah, we are not, this question, you can see the question is not basically about the financial instrument itself. Sometimes the question can give you a financial instrument and it can be at a discount. If it is at a discount and is the financial liabilities not through profit or loss, we capitalize the discount by subtracting it from the par value, because it is the company that is giving the discount to the company, or we are issuing the shares, or they are issuing the debentures or the instrument, the liability instrument at a discount. So we are going to give the discount to the people. So those people are going to enjoy the discount. So in this case, the discount will be an expense to us. So if you are capitalizing it, it means that you'll be subtracting it from your what? Your liability figure, the par value. Sometimes the company can also issue the instrument at a premium. The premium, the opposite of the discount is true for the premium. If you are issuing at a premium, it means that you will be receiving an amount higher than what? The amount that you are issuing. So the premium will be added because the premium will be an income. If you are capitalizing the premium, it means that you are crediting the account. So although I don't have question on the premium and the discount, you have to know that if you have a discount, the discount is treated as an expense. So if you are capitalizing an expense, it means that you are debiting. So you subtract from the liability. If you issue at a premium, the premium is a gain. So the premium will be having a credit. So having a credit means that you'll be adding to the liability. Take note of that. Okay, let's now come to the apportionment of the transaction cost. Apportionment of the transaction cost. The transaction cost will be apportioned based on their fair value. So debt will be having 164.6 divided by 1250 multiplied by 50 million. Equity will be having 185.4 divided by 1250 times 50. What will be their share of the transaction cost?
So debt is having 42.58.
Okay, equity will be having what?
7.416, sorry.
Okay, so what we'll do is that this cost must all be capitalized. So let's count the debt components. The transaction cost, if it is capitalized for debt component, we are subtracting, isn't it? Okay, so the fair value of the debt is 1064.6. Transaction cost 42.58. What will be the balance?
1022.02.
0.02. Okay, so we now calculate the finance cost on this one. The finance cost will now be calculated on the effective interest rate given to you, 13.2%. If there's no transaction cost, then we use the 12%. If there's no transaction cost, we use 12%. But since we are subtracting the transaction cost, it has not increased the effective interest rate. So we use the effective interest rate, taking into consideration the effect of the transaction cost. Okay, so what are we having? I'm having 134.91.
0.91. Yeah.
Okay. So there is no coupon payment for this year. So you will not subtract any coupon because the question says that there is no interest that will be paid in the first 2 years. So 1022.02 plus 134.91. I'm having 1156.93. Let's count to the equity. The equity, we have the fair value of, what is their fair value? 185.4. The transaction cost, is it going to be added or subtracted?
Added.
Subtracted.
Who is saying added? Equity, is it an asset? You are giving equity, so equity will be treated more like what? More like debt, because equity will be having a credit balance, and transaction cost is having a debit balance. So if you are capitalizing, means that you are going to be debiting the equity accounts. Okay, so it's not an asset. The equity is not an asset. Okay, So 185.4 minus 7.42. Yes, Senior Bumble.
Yes, sir, please. It's almost like you are done solving this question, but I missed the figure you had for the fourth year, determining the present value of the instrument.
The
The 1450.
0.63.
No, please. The 1450.
Of
Year 4.
year 4. Okay, year 4, they will be receiving the coupon for the last 2 years is 16% on the nominal value. The nominal value, which will be 200, isn't it?
Yes, sir.
At the end of the year 4, the instrument will be redeemed at par. The par is the nominal value. So it means that they'll be paying two amounts to them, the interest, and they'll also be paying the par
Okay.
value of the 1,250. So it
Okay.
means that they'll be receiving the two values at the end. That's why we add.
Okay. Thank you. Understood.
Okay, thank you. Let's pick so that is all. They say that so in the statement of financial position, you should set out how this will be treated. So you can just put the extract, you can put the extra there for them, or you can just explain that for finance cost of this one should be taken to profit or loss, whilst the convertible instruments should be separated, should be splitted. 1156.93 should be shown in the statement of financial position for this year, and 177.98 should be shown as other component of equity in the statement of financial position. The equity component is not remeasured. The equity component is not remeasured. Let's take I will send you some questions on the financial instrument again, then you try it. Let's take the last one so that we know that for financial instrument we are done.
Question 2. No entries have been made in the DL's books regarding modification of terms of the loan, except fees paid for the restructuring, which were immediately expensed. On 1 July 2022, DL entered into a restructuring plan to modify the original terms of a loan with a bank. According to the plan, DL will make a single payment of 920 million on 30 June 2027, instead of originally scheduled payments. The market interest rate at the time of restructuring was 15% per annum. On the restructuring date, the carrying amount of the original loan was 500 million cedis, while its effective rate was 11% per annum. The original loan was payable in equal annual installments in arrears, ending on 30 June 2027. A fee of 24 million cedis was paid for the restructuring plan. Required. Discuss with reference to relevant accounting standards how the above transaction should be dealt with in DL's financial statement for the year ended 31 December 2022.
Okay. All right. This is what we call a loan restructuring. Okay, where a company may be having a problem that they're looking at the terms and conditions attached to the loan that we have right now. We would like to restructure our loan payments. Okay, whenever there is a restructuring to modify the loan, or whenever there is a loan modification, the standard says that you should determine when the modification is substantial or is non-substantial. What do we mean by the modification is substantial? We look at the carrying value of the current loan that we have, and then we look at the present value of the new payment terms using the original effective interest rate. So maybe how much are we paying how much are we paying on on 30th June 2027? We are paying 920, isn't it? Please, we are paying 920. Is that correct?
Yes, sir. Yes,
Yes,
sir.
sir.
Okay. This 920, we are paying it. Today is what? 1st July, isn't it?
Yes, sir.
Okay. If today is 1st July and we are paying this one 1st July 2022, this is today's date, and we are paying this on 30th June, how many years from now?
5 years.
5 years.
Okay. So we find the present value of this value in 5 years' time. We are paying 920 in 5 years' time. What is the present value? The present value will be found using the original effective interest rate of 11%. So the standard says that look at the present value of the new cash flow or the cash flow under the modified term, compare with the cash flow under the carrying value under the original term. Look at the difference. If the difference is 10%, if the difference is more than 10%, or the difference has increased more than, or the increments in the difference or the reduction in the difference is more than 10%, then the loan modification or the modification is considered to be substantial. If it is substantial, what happens? We go and de-recognize the old loan. We remove the old loan from the books and now recognize a gain or loss on the new loan now, which is the present value of the new loan. That is what we do. If the increments or the difference between the amounts, either the increment or the decrease is no more than 10%, then it means that the modification is not substantial. You will still maintain the loan, you will not remove the loan, but you just bring the loan to the new value. So you also recognize a gain on it. The substantial means that remove the loan, you go and subtract the carrying value. But the non-substantial means that if the value is now 600 or the value is now 550 and the difference is no more than 10%, you just come and add 50 to this particular value, and that is all. And that 50 is an additional amount that you are paying. So you go and recognize the expense in profit or loss of 50. So you just come and add the increment to it. But if the figure should be 650, the present value should be 650, and you calculate and the increment is 10%, come and subtract all the 500 from this one and bring the 650 as a new item. And this 650, you are going to also recognize a cost of what? Or a gain, a loss of 150, because the loan is 500. You are now increasing it to what? 650. You are not receiving additional cash. It's an amount that you are paying. So you do it like that. So if it is substantial, you recognize a gain and bring the new loan now. Remove the old one. If it is not substantial, you keep the loan, the old loan, add the increment and also treat the increment as an expense or as a gain. That's how we go about it. So what we do is we now calculate the amount that we'll be paying. Let's calculate the present value of the cash flow under the new term. The present value, after calculating it, you add the fee to it. So you are going to be adding the fee to the present value. So any fee that the company has paid in relating to that will be added to the present value, because the present value of the fee is still the same as the value. So let's look at the present value of the modified cash flow. That will be calculated as 9 over, is it 920 or 950?
920.
Okay, 920 divided by 1 point. What is the effective interest rate? The original one. Is it 11%?
11%.
11%.
Okay,
11%.
exponent 5. I hope we are correct with that one. It will be 5 years. Or someone can also do it as 920 times 1 over 1.11 exponent 5. Anyhow you want to do it. What is the answer that we are getting?
571.2.
571.2, isn't it?
Yes, sir.
Okay. So this is the present value. Then we now find a total by adding the cost to it, the fee that we paid. So it means that the total amount that we are paying, so the total cost or the total present value will now be the 571.2 plus the fee of 24. How much are we having?
595.2.
Okay. The fee is 24. So that is the total amount that you should be paying will be 24 plus that amount, but you have already paid a fee. So that is the total amount that you should be paying under this particular one. That will be.
Hello, sir. Please, it seems the figure is 545, rather.
If you discount 5 years.
Yes.
Can someone confirm the 545?
Yeah, it's 545.9.
Yeah.
So 546 approximate.
Okay, let's
Yes.
use the 546. Okay. Okay, so it will be 546 plus 24, isn't it? What are we having? 570.
570.
Okay. What is the carrying value of the old loan? Is 500. What is the difference between them?
70.
So what is the percentage of the difference? What is the increment? So it will be the difference over the original value times 100. What are we getting?
14%.
14%.
So divided by 500 times 14%, isn't it? Okay. Is the increment substantial?
Yes, please, it's substantial.
Okay. So if the increment is substantial, you can see that there is a increment of what? 70, isn't it? Okay. This 70, this is how you are going to recognize it. Okay. This 70, this is how you are going to recognize the 70. Okay. You can see that included in this 70 is what? A transaction cost, isn't it? So the transaction cost will be amortized over 5 years, which is a fee. Or someone can decide to write off the fee to profit or loss at once. Okay, but the fee, since you are paying the fee relating to a loan that will be consumed over 5 years, someone can amortize this for 5 years. So the gain that you are going to be having right now, the expense that you'll be charging to profit or loss, so you'll be having the expense will only be 46 million, which is the immediate amount. You see that the loan is increasing by 46. But the 24, the 70, there is a transaction cost of 24 inside. And that transaction cost can be amortized over the 5 years. So we are going to be recognizing expense of 46. But if you recognize the expense of 70, it means that the transaction cost is just a one-time expense that you are recognizing. There's no problem with that too. But since the instrument is going to, or the loan is going to be there for 5 years, it will be acceptable if the transaction cost is also consumed over the 5 years. So at the date of this particular transaction, which is July, the company will be recognizing a loss or expense of 46 million. From July to December, the fair value of the loan. So the company will remove the loan. They will remove the loan and now bring it to 46. There is no problem with that. So the loan will now be 456 million. What will happen? We will charge a finance cost, which will be 0.11 times 546 times 6 over 12. Because why is it 6 over 12? The restructuring, the modification was done on 1st July, and we are preparing the statement for 31 December. So we charge a finance cost for only 6 months. So you charge the finance cost for 6 months, and your transaction cost also will be amortized over 6 months, because we should calculate effective interest rate, taking into consideration the transaction cost, but we haven't done that. So let's look at the finance cost for 6 months. 0.11 times 546 times 6 over 12.
30.03.
Okay, 30.03. So the total value of the loan, 546, will be 576.03. There is no payment of interest yet. So your transaction cost will also be capitalized, or someone can decide to write off the transaction cost to profit or loss at once, but that should be capitalized. So transaction cost will now be 24 over 5 times 6 over 12. What are we getting?
2.4.
Okay. So in the statement of profit or loss this year, you recognize the transaction cost of this figure and the amortization of the transaction cost. But in the statement of financial position, you will be showing your loan at 576.03, and you'll be showing your transaction cost or an amortized transaction cost, which will be an asset at 24 minus 2.4, 21.6. So if you want to account for this, just find the present value of the new amount that you'll be paying under the modified terms using the original effective interest rate. Add any fee to that particular value and compare with the current value of the old loan. Calculate the difference in it. If it is more than 10%, either decrease or increase, we say that it is substantial. So the original loan must be removed and be replaced with the new amounts now. Then you will now capitalize your finance cost. Then you will now charge interest on the new loan now. That is how we go about it. It's a very new thing that most of us are hearing. But the beer very fine.
It's not easy.
Okay, serious. So basically,
Sir,
yeah, senior.
you see, I see it's not fair to us.
Life Angasa is not fair.
You have to be doing all these adjustments within 3 hours.
Oh no,
You
this
are
you
supposed
see,
to answer.
this right now you can see that they are slowing the standard for the financial reporting exam. It's now corporate reporting that they are raising. The standard for the financial reporting exam is now low. Okay, it's not that low, but last sitting was cool. Okay, last sitting was cool because if you look at how they have been examining the question, last sitting was cool. But it's not anything, you can do it. You can do it. You just have to give out your best. At least just prepare, at least have the thing is not difficult though. It's because we are not getting time to learn. That is the only thing. The exam Ankasa is not difficult. It's not difficult because if people say that because you have heard, that is why you are saying that. But it's not difficult. Me, I'm a lazy student. I don't.
The 50%, the 50% is not easy.
No, it's easy. It's because
50% is more than 2,000%.
no, it's because you are not working for the 50% very well. You first have to identify what your 50% is. That is the first thing. If you pick a question paper, don't open it. They say do not open until you are told to do so. If you don't know you want to pass protocol, you will be scared because you see a question, you don't know what to do. Fear will enter you. That is the end of it. You cannot do anything. Your confidence level is down. So how do you boost your confidence level? How do you identify where your 50% is? My brother, start answering the theory questions first, because that one is subjective. So the way you understand it, write the English. Start answering. Okay, start answering with a theory. If you see some theory questions, there will be a question on conceptual framework. There will be a question on ethics. There will be some theory question on consolidation. You can use those ones to boost your confidence. Or you can use ratio analysis, though sometimes the ratio used to take time. For me, I have been doing the ratio as a last question because that really takes my time. But if that is where your mark is, use that particular question to boost your confidence. Don't go there and start doing standards that are very difficult or that are issues that you don't have enough knowledge over. You can also use question 1, consolidation, to boost your confidence. How do you boost your confidence? You start putting the skeletons there by adding. So they ask you for statement of financial position. Don't read a footnote. Don't bother yourself. Statement of financial position, you know that consolidation, you are adding the items of the subsidiary and then the parent. Associate is not part. So add the items together before you come to the foot. That particular addition will also give you vim. It is boosting your morale. Then from that side, you can take the footnote. Start with the group structure. Start with the net assets. They will give you the retained earnings of the parent. Go and open a group retained earnings over there. Put their figure there. They will give you the figure for NCI. Go and open the workings for the NCI. Put the figure there. They might give you purchase consideration. Go and open the workings for goodwill. By opening these things, you have some confidence. Then you can now be tackling the footnotes one by one and be doing the adjustment that you can do. Don't say that, okay, you are not able to adjust most of the footnotes. So no. Some of the footnotes are not for you. So leave it for the person that it is for. Move on to other things. So boost your confidence level.
Thank you, sir.
Important things and move on.
Go for the notes that is for us.
That is for you. Some of them are not for you. So just go for the ones that are for you. You can't be there and be hating yourself that you are not able to do this one. No. My brother, move on. Life is too short.
Yes, sir, boss.
Thank you for the advice.
Thank you, sir.
Life is too short.
You go there and say you want to go and score. No, you are worrying yourself. They will not write have you seen transcript before? You think that they will write the mark on it? No. Pass. That is it. They will write the right pass. If someone has gotten 99, it was all pass. All of you have passed. That is none of your business. Look for your 15 marks and work for it. That's all.
Okay. Thank you.
Tomorrow.
Thank you very much, sir.
All right. Tomorrow we shall continue with the standards.
Okay.
All right.
Sir, please, what time?
It's the same time, 6:30 to 10:30 p.m.
Okay. We are grateful for today, sir.
Okay.
God bless you.
Thank you.
All right.
Thank you, sir.
All right. You're welcome.